सुन, इक्विटी में इन्वेस्ट कर, ग्रोथ का है चांस।
सुन, डेट में है लो रिस्क, बात मेरी मान।
अरे बेटा सुन, गोल्ड सिर्फ गोल्ड, मैंने भी यही किया।
सुन, अब तू कंफ्यूज मत कर यार।
अरे मतलब सुन सबकी कर मल्टी मतलब मल्टी एसेट एलोकेशन फंड यानी 3 in 1 फंड। ये इक्विटी, डेट, गोल्ड तीनों में एक साथ इन्वेस्ट करें। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेज ध्यानपूर्वक पढ़ें।
How can I achieve my targets? How can I target the remotest markets?
You only progress when you ask better questions. Mint. Think ahead. Think growth.
सुन, इक्विटी में इन्वेस्ट कर, ग्रोथ का है चांस।
डेट में है लो रिस्क, बात मेरी मान।
अरे बेटा सुन, गोल्ड सिर्फ गोल्ड, भैया ने भी यही किया।
सुन,
अब तू कंफ्यूज मत कर यार।
अरे मतलब सुन सबकी कर मल्टी मतलब मल्टी एसेट एलोकेशन फंड यानी 3 in 1 फंड। ये इक्विटी, डेट, गोल्ड तीनों में एक
All right. Wow. I'm so tempted to say itna sannata kyun hai bhai, but this is not a Bollywood show. Good evening everybody. Listen, we had, they say there is more energy in chai and coffee than all the distilled alcohol in the world, and that is the reason why we've not opened the bar so far. So I'm expecting some more energy in the room, all right? So let's try this once again from the top. Good evening. How are you? Good? Unsure? Not sure, hanging in there. Oh, I don't know what to expect. Doesn't matter how you feel. I can assure you that by the end of this evening, you're going to go from feeling all of this to feeling phenomenal. You know why? Because with every single conclave that we host here at Mint, we make sure that all the conversations that we have on this stage, at least, just become not just grander and greater, but they become more meaningful. And that's exactly how we have designed this evening. Other than that, I must also say, as someone who's been observing the room and, kind of trying to catch a vibe, I've got a pretty great vibe. I think this evening we're all really in the mood to give it a go. So welcome everybody. Welcome to Mint Mutual Fund Conclave 2023. Don't look so serious. Please smile. And that's your cue for a round of applause. Come on. So usually, I'm the one, by the way, my name is Zenia Fernandez. I'm going to host this evening for you. And usually, I'm the one who sets context. I tell you what's going to happen and all of that. But today, I thought, let me turn the tables a little bit and let me ask you, why are you here? So, earlier this evening, while I was grabbing some chai, by the way, I've quit caffeine for 30 days, and believe me, I feel brilliant. Maybe that's the vibe I'm catching. It's great. Try that. All right. So, like I said, I'm going to, I met Mr. Singhi, who's seated right behind, like he's possibly the last person seated in this room. And, usually in school and college, they say the naughtiest people sit, are the backbenchers. But then in real life, we all know they're also the brightest people. Mr. Singhi, tell me, what are you expecting from this evening?
I think there'll be some good insights. Some of my friends are speaking on the panel, so that'll be good. And obviously, once the bar opens up, it'll be great fun.
Ye dekho na. Absolutely politically incorrect answer. Guys, we need to edit the last sentence, all right? But I'm going to, okay, the showrunner gives me a sign. Let's go quick. All right, so I'm quickly back to the stage, everybody. And as you can see here, right on the stage, it says, thriving in bull, bear, and sideways markets. So all of our speakers, of course, have kind of, designed their conversations around this subject. But before we get to inviting and setting the tone for today, I want to first invite all of you to take all the conversations happening on the stage online, all right? Because there is a huge part of our community that is not in this room right now. While you do that, please don't forget to use our official hashtag for today, which is hashtag MintMFC 2023. And please do tag us at Live Mint. So you can keep your cell phones on the silent mode, but keep them handy. Share anecdotes, share your thoughts, share your opinions about whatever the speakers are talking about on stage. And of course, in case you're capturing videos and selfies, please tag us too. Another very important and crucial aspect of hosting an event like these are the partners, you know, the ones, the brands, and the people that come on board and support us to making this happen. So a huge shout out to our partners. Axis Mutual Fund, we have Bandhan Mutual Fund, Baroda, BNP Paribas Mutual Fund, ICICI Prudential Mutual Fund, Mirae Asset Mutual Fund, and UTI Mutual Fund. Can we have a huge round of applause for our partners, please? All right, so without any further ado, to officially welcome all of you, it's my pleasure to invite on stage Deputy Editor Mint, Neil Barate.
Hi everyone. So those of you who have read my articles will know that I'm a man of few words, and I'm going to keep it that way, very short and very sweet. My first boss, Dhirendra Kumar, told me that you treat words like you're spending money, so you use as few as possible. And those of you who read our stuff will know that we try to do that through infographics. One infographic says, hopefully, what 1,000 words cannot. All of us in this room, all of us in this country today, live in an incredibly lucky time. We are in the fastest growing major economy. It's a lottery of birth, right? We could have been born during my grandparents' time, or during my parents' time, when we didn't have as good a functioning stock market, as smooth a mutual fund industry as we have today. And we have that privilege. And it's not just the GDP numbers, it actually, you feel it in your life. When I came, so I live in Pune, when I came from there, for the first time I was able to take a metro from my house all the way to Pune station. Got right into the station and was here. It feels like a small thing, but it's a tangible sign of this country progressing. Just as the infrastructure of this country is being built, we in this room essentially build and look after the financial infrastructure. We're all plumbers. We're all plumbers of that system, and we keep the pipelines free of blockages. We direct the water, right? It's connected to the real economy, because if there is misallocation of capital, if we don't do our jobs well, there will be misallocation of capital, and then the real economy will suffer. So actually all of us here have a higher purpose. We don't think of it that way. We think of it usually in terms of private profit. But if you think back to Adam Smith, right, the butcher, the baker, and the candlestick maker, in doing their own jobs, in finding their own self-interest, actually contribute to the common good. So this is really a chat between a bunch of plumbers on how to direct the flows, how to ease up the pipelines, how to make the financial system of this country better. Now, let me introduce our keynote speaker. He needs no introduction, but I'll talk about the one quality that truly inspires me above all else with Anant. He's had a tremendous career in banking, in academia, but perhaps more importantly than all of that, as a regulator, he comes to events like this to speak, and more importantly, to listen. He listens to the industry, he listens to consumers, he listens to the media, and that's something that's extremely unusual. It gives me hope for this industry. It gives me hope for all of us here. So with that, let me invite Anant, and thank you all of you for coming and giving us your valuable time. Zinnia will just quickly...
Sure.
Yeah.
Absolutely, ladies and gentlemen. First of all, let's have a round of applause for Neil, because clearly the thinking man. And now let's have a round of applause for the most influential voice in the room, Mr. Anand.
Thanks a lot, Neil. I don't have a prepared speech. My last job was as a professor, so please be ready for a long lecture right now. Thanks a lot to Mint for having me here. It's a pleasure as ever. You've made it a nice annual event of sorts, which is very, very good. And thank you all for the excellent job you're doing in financial education. Please keep up the good work. What I thought I'll do is, while this is about mutual funds, I thought I'll go a little behind that. Thanks to this particular event, I had the time to reflect on the last 10 months of my stint as a regulator, which is a new stint for me. And I thought I'll cover a few areas which kind of sum up my experience from the last 10 months. First, a reminder to myself and to everybody on what SEBI's purpose is supposed to be and what we try to do for a living, which kind of drives us every day. So I thought I'll cover that first. Second, to Neil's point about us being in a very unique time in this country's fortunes, the fact that there is digitization going on is also reflecting in the financialization of savings, and I think it's the capital formation is in a very unique spot, so I want to talk a little bit about that. Third, I want to talk about some of the regulatory challenges that we face, right? And what is the thinking behind, how do we go about actually framing regulations, and what's the thinking that we go through. And finally, some areas which we need your help on to ensure that this capital formation trend that we are seeing continues into the future as well. So let me start with the first part, which is SEBI's purpose. So those of you who have had the misfortune of reading through SEBI's Act, the preamble starts by saying there are three pillars to our existence, to SEBI's existence. The first is investor protection. The second is market development. And the third is market regulation. These three form the key part of our existence, of our mandate. All of this put together talk about capital formation. It's about capital formation. So we're often seen as a regulator. What we try to keep in mind and what you should keep in mind is our job is not just to regulate. It's to ensure that capital formation continues in this country. That's our mandate. If you're doing only regulation, if you're only telling you no, we are not doing our job. We should be actually ensuring, along with you, that this capital formation goes along. I will come back to this theme of capital formation when I talk about the regulatory challenges, but I want to quickly talk about some of the things that we are seeing on financialization of savings. Now, these numbers are very familiar to you, but it's still important to remind ourselves about some of these numbers. So we know that we are in the midst of this massive formalization, which is standing us in good stead. It's about the telecom revolution. It's about the payments and settlements ecosystem. It's about the financial inclusion through Jan Dhan Yojana, etc. That's also translating into a lot of financialization of savings, which you as an industry are a part of, and you're seeing almost every day. So you know the numbers. The latest Telecom Regulatory Authority of India numbers suggest we have more than 117 crore telephone subscribers. We have over 85 crore internet users, and that number is growing. So that's been a real telecom boom at the underpinnings of our digitization. You know that Jan Dhan Yojana accounts have really caught on. There are more than 50 crore accounts now of Jan Dhan Yojana. 56% of them, by the way, are in the name of women, right? So there's a fair amount of financial inclusion which has happened. And of course, our payments and settlements ecosystem, I could give you several numbers about that, is one of the best of the world. It's really doing a splendid job. Now, what it means for us as an ecosystem, the securities ecosystem, is we are seeing formalization of savings. And it's starting with the fact that the formal sector is doing extremely well. Again, you know these numbers very well. CMI tracks the data for 5,000 large companies, largely listed companies, on an annual basis. Their profit after tax has been increasing by 31% CAGR, compounded annual growth rate, over the last 5 years. It's a remarkable period. We've not seen this kind of growth for the last 10, 15 years. It's a remarkable period that we are seeing. And remember, this is pre-COVID to now. So we've actually seen phenomenal growth, much more than the nominal growth of GDP in this country. So that's one underpinning as far as the real economy is concerned, the large companies are concerned. It's also reflected in the financialization of savings. So 2018 March, we had about 3.4 crore demat accounts. and now we have over 12 crore demat accounts. Across demat and mutual fund, unique subscribers, and thanks to our PAN, we actually know how many unique subscribers there are. That number used to be about 4.5 crores 4 years ago, 2019 or so. Today, it's for the first time crossed 10 crores. We have more than 10 crores investors through mutual funds and through direct equity, demat account holdings. And that number continues to grow. And all of this, by the way, we have more than 51 crore PAN Aadhaar linked accounts right now. So that's the underlying denominator that we're looking at. All of this actually is translating into greater financialization of savings. You know the numbers. Your industry, the mutual fund industry, has now crossed 46 lakh crores of AUM. It's grown by more than twice over the last 5 years. And other industries, the PMS industry is now more than 28 lakh crores, including EPFO. AIF, alternate investment funds, the commitments have gone up from 1.7 lakh crore 5 years ago in 2018 to 8.3 lakh crores, almost 5 times in the last 5 years. It's a phenomenal CAGR. So these industries are growing really thick and fast. Every year, we are seeing IPOs of about, on average, 2 lakh crores coming through. We are seeing fresh bond issuances of 7 lakh crores coming through. Over the last 3 years, InvITs and REITs put together have raised more than 1 lakh crore. It's a unique period. We've not seen this kind of capital formation or financialization of savings ever in this country. Just for 2 seconds, I think the entire ecosystem deserves a round of applause. Okay? The entire ecosystem. This is mutual funds, this is AIFs, this is PMS, this is distributors, this is advisors, brokers, all the market infrastructure institutions, this is media such as Mint. The entire ecosystem has contributed to this. None of us is perfect, but we've tried to do our best, and we should take pride in what we've achieved. It's only for 2 seconds because there's absolutely no room for complacency. And I think you'll all agree with that. On 2 counts. One, we can't take this trend for granted. This is a trend that has to be nurtured and protected. And second, there is a long, long way to go. As I mentioned, if there are 50 crore PAN Aadhaar linked numbers already, and we have only 10 crore investors in the ecosystem across mutual funds and through direct securities, there's a long way to go. And I'm sure the numbers will keep growing over time. Now, we've tried to play our role through this process as SEBI. And very quickly on those 3 pillars, I can list a few things that we've tried to do. So if you look at investor protection, which is our first cardinal pillar, whether it is things like enhancing the disclosures that's coming through the ecosystem, whether it is trying to protect client money which is lying with brokers, whether it is actually taking a lot of steps, and you would have felt the pain of this as far as cybersecurity is concerned, ensuring that the cyber audits are conducted properly, that we have portability across the market infrastructure institutions, that there is redundancy, and I'll talk a little bit more about cyber risk as we go along. So we've tried to do our bit as far as investor protection is concerned. Market development as well. I think T+1, and I wish I could take credit for it. It was done before I joined SEBI. It was already cooked up and baked up by that time. T+1 is really, really a fantastic move for our ecosystem. We were told by external people that, you guys are going against the grain as far as best market practice globally is concerned. And guess what? Now the US Fed is going into a T+1 ecosystem for the next year onward. It's already been announced, right? So in many ways, we are leading the pack on this T+1 ecosystem. Likewise with InvITs and REITs. Now, I'm sure we'll grow a lot more out there, but the finance minister had come down to inaugurate our limited purpose clearing corporation and the backstop facility, which you guys helped create. She actually complimented us in SEBI for the progress made on InvITs and REITs, and we have a long way to go on that particular front. What I quickly mentioned in terms of a backstop facility for corporate bonds, a long-standing request and demand from the industry, that's finally come through. A repo corporation for corporate bond repo, again, that's come through. All these are examples of what we've tried to do as far as market development is concerned. Market regulation, the 3rd pillar, again, that's an area of a lot of interest and focus for us. I can give you several examples, but something that you have seen happening is the regulatory action that we've taken every time we've seen any kind of wrongdoing. whether it's front running, whether it's insider trading, whether it's manipulation, whether it's inducement, whether it is siphoning out of money from the company, we have not hesitated to take action. Where we see wrongdoing, we will take action. That's going to be because we need to protect trust in this ecosystem. Now, I'm going to talk a little bit about this trust part in the ecosystem. You know, while we take a lot of pride and we're comforted by the growth of the mutual fund industry, which all of you need to take credit for, it is a tale of two cities in many ways. So if you look at the equity part of the AUM, right? It used to be about 2.5 lakh crores 10 years ago. It grew to about 9.5 lakh crores 5 years ago. Today it's over 25 lakh crores. So it's 10 times over the last 10 years. It's a CAGR, I think about 30% or so per annum. It's a staggering growth. Again, it's helped by the fact that market valuations have gone up, but nevertheless, the actual growth in that number is just tremendous. The last 5 years, CAGR is over 20% in terms of actual growth. It's a phenomenal story, and again, kudos to you guys. Now, I'm going to contrast that with what we've seen as far as debt funds is concerned. Okay? 5 years ago, May 2018, the total AUM in debt funds put together, so the corporate bond holdings, not your CPCDs, not your government bonds, the pure corporate bond holdings was in the region of 6 lakh crores as of May 2018. As of May 2023, it's below 5 lakh crores. It's actually come down, the corporate bond holdings. Now, between 2013 and 2018, even this ecosystem saw a good dramatic rise. It was going at about 26-27% CAGR. And then in the last 5 years, it's actually plateaued and gone down, not really gone up. Okay? And it's something for us to reflect on. Now, you're all experts here. I'm not going to pretend there is any one reason why this phenomenon was observed, as to why there's this tale of two cities across debt and equity. There are plenty of reasons: monetary policy, things outside of our control, real interest rates, and so on and so forth. But I would hazard to guess, as a part professor previously, that the events which happened between 2018 and 2020, in terms of ILFS, in terms of DHFL, in terms of the 81 fiasco, in terms of a set of funds actually having to close some of their funds for redemptions, that did hit the trust in the ecosystem. There was a point in time which I'm sure you as mutual fund distributors would have, and mutual fund stakeholders would have seen, where investors were actually saying, you know what, equity is safer than debt when it comes to mutual fund schemes. Now, we are working really hard to change this absolutely absurd notion that equity can be, or rather debt is riskier than equity, which is why this this corporate bond repo market, this backstop facility, hopefully we'll make progress along those lines. But the point is, our financial services ecosystem relies on trust, and if that trust has a chance to be shaken, that has long-term impact. It can actually hit capital formation for several years put together. The reason I'm giving this song and dance is, while we celebrate the trend currently in terms of actual capital formation, all the numbers I told you, we've got to be very conscious that this is a trust that we have to preserve, right? And we can't afford to let this trust slip. Alongside this, we've got to also introduce new products. We've got to introduce new things so that this numbers continue to grow. As capital formation is absolutely essential for us to achieve our immense economic potential. There's no doubt about it. We need this industry to grow. So we need both, preserve the trust as well as grow at the same time. This is what I call as our regulatory dilemma. The fact that we have to do both together, develop as well as preserve the trust. Now, there was one of the board notes that we've now made public in the last June board meeting was on requiring enhanced disclosures from certain FPIs, which we call reportable FPIs. And we described as to why we, so that there is no, circumvention of minimum public shareholding or SAST, substantial acquisition of shares and takeovers, press note 3, etc. Because of that, we'd asked for enhanced disclosures. Now, if I would encourage you to read a portion of that particular note because it describes SEBI's dilemma very well. What we were asking for in terms of enhanced disclosures is onerous, okay? Which means the chances that we do type 2 errors, where we impose very high requirements on good people who don't need to go through those requirements is very high. That's a type 2 error, where I say no, where I should be saying yes, where I come in the way when I should be getting out of the way. That's a type 2 error. The type 1 error is where I let a bad thing happen. I could have stopped it, but I don't stop it. I should have said no, but I said yes. That's a type 1 error. We are very conscious that we have to minimize both. So if you're looking to do something to launch a new product, which is reduce type 2 errors, which is say yes, we have to be very conscious that we're not increasing type 1 errors, right? If you're doing something to reduce type 1 errors, which is slam the brakes on something, I have to be very conscious I don't increase type 2 errors. And this is a dilemma that we go through. If you look at it, ultimately, there's no dilemma. You can't grow the ecosystem without trust, which means I need to minimize both type 1 and type 2 errors. Now, I'm going to talk about a few areas, 2 or 3 areas, depending on the time, which I think continue to be areas which we are focusing on, and we need help from you as market participants as we navigate through this particular thinking process. The first one sounds like a simple one, but it's something which is top of our mind, which is the cybersecurity risk. As we digitize, as we become more and more dependent on digital solutions, it is incumbent upon every one of us in the ecosystem, whether it's the mutual fund industry, whether it is the market infrastructure institutions, whether it is regulator, whether it is the investors, to become more and more adept at managing cybersecurity risks. The reason why we are beating so hard on ensuring that your vulnerability assessment and your penetration testing tests are done accurately is exactly this. The reason why we are pushing so hard to ensure there is portability of data across institutions is exactly this. We want to take care of cybersecurity risks. I think, increasingly amongst your CXOs, you need to have empowered technology people. Currently, and at least in my time, 20 years ago, 10 years ago, what you required to succeed in the financial services ecosystem was client knowledge followed by domain knowledge. I think now it is client knowledge followed by technology knowledge. That has to be the way we go as far as managing our ecosystem is concerned. So I'll leave that particular part. The second part is on education, right? A very intrinsic part of financial inclusion is that we have to have good quality education going through. So if you need that 10 crore people to become 20 crore, you can't do it unless you're reaching out to the people and explaining to them risks, returns, risk profiling, asset allocation, things like that, right? You need that education to come through. And this is an area where there is a bit of a dilemma, because on one hand, we need good quality education and we need to let educators, do their job. On the other hand, we've got to ensure that the quality of education is good, that there is no inducement, there is no misleading stuff, there is no fraud, there is no manipulation of any kind, and there is no perverse interest, that you're actually pushing products which makes you more commission rather than what is suitable to the client. And this is a dilemma that we have to navigate together. You know that SEBI does not do things alone. We go through a consultative process. We have a lot of discussions with industry groups. We then have discussions with the advisory groups. And we bring out consultation papers, and then we ask your feedback. Only then do we take stuff to the board. This is an area which is going to require a lot of discussion on how do we ensure quality education and financial inclusion, at the same time ensuring that the wrongdoers, so to speak, do not spread perverse incentives or do not manipulate or do things which are wrong for the market and destroy the trust in the ecosystem. That's going to be a big area. Chairperson Madhi Puri Butch actually mentioned that we are working on what to do with influencers in the last board meeting, last board meeting. There is intense discussion happening within SEBI on this subject, on trying to do a lot of things, including how do we ensure that the legitimate ecosystem of distributors, advisors, analysts are protected and segregated from those who are not registered? How do we ensure that the oxygen for the influencers who are doing manipulative stuff is actually taken away? How do we ensure that perverse incentives are reduced? How do we ensure that best interests of clients are actually maintained? And therefore, the education happens in a good, normal way. In fact, wearing my professorial hat, there was this question which used to come up in the past, which is, who makes a good investor? Is it women or is it men? And by the way, there's an actual research paper on this subject written by Barber and Odian, I think around 2005, very provocatively titled Boys Will Be Boys, which goes on to show a short story that women in the US, as per the sample that they chose, tend to make 1% more per annum than men on an annual basis. Single women make about 1.5% more than single men on an annual basis. Now, it was half tongue-in-cheek. I'm just quoting what the paper says. For this paper, there are plenty of papers on the other side as well. It goes on to say, actually, this is a rubbish correlation. You can't do a single variable gender versus return. You've got to look at multivariable analysis. It goes on to say, the reason for this is that men, I don't say this, the paper says this, men tend to be confident. They think they know more, so they trade more, and therefore they make less. Women tend to be less confident, and therefore they tend to trade less, and therefore they tend to make more. Broad message being, guess what? Don't do too much of in and out. Hold the portfolio, and that will make you your best returns, on average. Now, I'm not quoting this, it's the paper that's quoting this. But this is the kind of education with research that we would like, disseminated to the people for them to be aware of, so that they can take their, we're not a nanny state where we're going to say, you have to invest here, don't invest there, please invest there. But be aware of the facts. Our research, which showed that 9 in 10 individual traders in the F&O segment actually lose money, is merely a disclosure. Now, after that, you still want to trade, be my guest. It's your hard-earned money. I'm not going to stop you, right? So education is going to be a big, big part of our thought process as we go ahead. How do we spread the good word in a trustworthy, in a stable, consistent and sustainable manner? Final one, where we see wrongdoing, where we see things which are egregious and can shake the trust, we will have to take action. And one school of thought is, SEBI, you take care of all of this through enforcement. After all, you're there, you've got powers, you've got 11B, you've got all these things, go and take action. My submission to you is, maintaining trust in the ecosystem is too valuable a job to be left to the regulator alone. Left to ourselves, we are like the old Hindi movie that, the police fellow who comes in the last scene after the entire climax is over, then does hide high when everything is over, right? We are the last people to find out, right? You are the guys on the ground who know exactly what's happening. For everything that's gone wrong in the market, when we have discussions with the market folk, they tell, हाँ, ये तो पता था हमें हो रहा है ये. अरे तो बताओ ना यार. So tell us about it. So this maintaining trust in the ecosystem is not just the regulator's job, it's the job of the entire ecosystem. And the good news is we are building that trust, at least with your ecosystem. Thanks to all of you, thanks to the Amphi universe. I think there's a lot of good dialogue happening where that trust is growing. We need that to happen with all regulated entities as well. What our vision then would be is that we will enunciate the principles and the regulatory intent. Then we hand over the actual description of what that means in terms of circulars, in terms of standards, to a committee which is led by you as the industry, because you understand how the industry works the best. So we tell you what our intent is, you translate that into standards which the entire industry can be held accountable for, and we will be happy with that. We will treat those standards as if it's our own circular. That's what the chairperson announced for the companies vis-a-vis that new forum which is being started. We would love to do that with mutual funds. We would love to do that with alternate investment funds. We would love to do that with investment advisors, with the entire ecosystem. We give the principles. You as industry folk tell us what are the standards that you will therefore live by. So I'm going to stop here. I've already overshot my time, and I've got a red blob here saying time's up. We are in a good space, like Neil mentioned. I think we are in an excellent space. The trends over the last few years have been extremely heartening. When foreigners, foreign portfolio investors come to visit us at SEBI, we are the ones trying to sound conservative and saying there are risks. Those guys have all horns. No wonder they brought $20 billion already into this fiscal year. They're having the horns and telling us that we are missing the wood for the trees. Look at China, look at South Africa, look at Brazil, and where do I put my money? I have to put it in India. So I think we're in a sweet spot, but there's zero room for complacency. While you should take a bow for the growth that we've achieved so far, and kudos to this entire ecosystem, We have a long way to go, both to preserve the trust and to grow this ecosystem. We need your cooperation. We need your insights, your education to tell us what are the soft spots where we need to concentrate on. We intend to involve you a lot more in the implementation of regulation and the conversion of our regulatory intent into standards. I'll stop here. Thank you so much. I really appreciate this.
Thank you so much. Can we have a louder round of applause, ladies and gentlemen, because this is what we call a keynote address, sir. I think your keynote really offers us, as a community, it gives us just a compass for making well-informed choices. And the weight of your insight is going to guide us into a labyrinth of possibilities for all of us as a community and for our organization. And thank you so much for continuously in your, speech highlighting the bedrock of our success, what has been for us, which is the unwavering trust. So thank you. Thank you very much for your valuable time and insights. We're going to take this energy and this enthusiasm and move into our first power panel for today. It's titled Debt Fund Tax. What solution does the mutual fund industry have? Clearly, this is the panel where we're looking to get some innovative solutions and strategies for optimizing returns while managing the challenges that we face. First up, I'd like to invite our moderator for this discussion. Welcoming back on stage, Neil Barate, Deputy Editor, Mint. Neil, welcome back. That's your spot on the stage. And without any further ado, let's invite our panelists for this discussion. Sandeep Jethwani, co-founder, Deserve. We have Neil Parekh, CEO, PPFAS Mutual Fund. Ashish Somaya, CEO, White Oak Capital Asset Management Limited. And Vinita Jain, Director, Pay It Forward. Everybody, let's give them some energy in the form of a round of applause so that we get some great insights. Neil, over to you.
So I think Anand spelled out the issue here at hand, the main issue, which is that equity has grown massively in the mutual fund AUM, in the mutual fund industry. Debt has not. And the tax change in the last budget has made things a lot worse for the debt side of the mutual fund industry. But behind every dark cloud, there are always silver lining. There's always silver lining. And that's what we will discuss today. So first, let me get some views on from Vinita and then Sandeep, so the non-mutual fund CEOs, on what it was like. I mean, you talk to a lot of retail investors. You conduct programs, education programs, especially for women. And you would have set some principles about when to invest in debt funds, when to invest in equity funds. Suddenly, when the tax changes, how do you deal with it? Like, the best laid plans of mice and men come to naught, right? So how do you deal with it?
I think the first thought is always take a pause, understand what the changes are, and not panic, because the first thing that we tell all the investors, because they're very small time investors, so whether any type of a change, what kind of an impact, we all need time to understand what the changes mean. So first thing is always that, and then of course then you try and come up with solutions. You tell them, like, whatever you have, like, pause, understand why you got into the debt fund initially. And if there is, still the silver lining, as we call it, that, there is still some positives about the debt fund and we should not be panicking. And continue with the positives, explain to them that there are ways out and the tax system will always change. So, you cannot deny that 1 year to the next year. So it cannot be based on the tax rules that come up with. But you continue more with your goal settings and things like that.
Yeah, so if you remember, I mean, equity also has had so many changes over the years. We went from a system of no tax, no long-term capital gains, to the 10% that we have today, and we don't know what will happen in the future. So Sandeep, same question. How did once you make plans, you tell people, and suddenly the tax changes?
So Neil, let's put things in context first, right? We've analyzed over 90,000 portfolios. Typically in the smaller portfolios, and I call smaller as being 20 lakhs and below, we've seen over 90% allocation being in equity instruments, right? So, but if you look at larger portfolios, which is sizes over that, that's where we see an allocation to this asset, which is the debt funds. And those are therefore the portfolios that got impacted. The smaller portfolios, I think when you're building a portfolio, first you'll allocate to PFs and FDs and then eventually equity mutual funds, right? Whereas on the larger portfolios, there was definitely impact. In the month of March, we saw tremendous inflows happen in the fixed income category because everyone was trying to lock in the yields, one, but two, get benefit of the grandfathering that the tax regime was offering as of 31st of March. Post that, we have seen a significant cool off from affluent and affluent plus investors in this category. The concern that we have is twofold. First is because of this, incremental allocation has gone more towards the equity side. And that sort of explains the fact that fixed income mutual funds haven't grown. The second is actually more concerning, which is allocation going to other instruments which are of the nature of fixed income, right? Which is in the category of direct bonds or even P2P lending, lease financing and so on, right? So we
MLDs.
see across the board an increase in risk profile in portfolios right now.
Yeah, so, typically when the government closes one door, they forget to also close the windows. So you have this strange situation where if you invest in a debt fund, then regardless of your holding period, you will be taxed at slab rate. Whereas if you directly hold a bond, after 1 year, you're taxed at 10%. And that's actually shifting people towards more risk, especially for small investors because, they might be buying maybe 1 or 2 bonds or a small portfolio. It will never match the sheer diversified nature of a debt mutual fund. So now let me come to the MF CEOs. Neil, if I can start with you. PPFAS just yesterday filed for an arbitrage fund. So I think that is your solution number one. But if you can elaborate on arbitrage funds and how you will manage yours.
Yeah, so first thing is there are two certainties in life, which is death and taxation. So we have to live with it. We've lived with it over so many years that there are going to be tax changes. We are transforming as an industry. So we will see more level playing field and taxation changes. So we need to be ready for that. So one thing is that for people why we launched the arbitrage fund is that, or we've applied for the arbitrage fund is that for the people in the higher tax bracket, if they want liquid fund-like return or they need money for less than 1 year, then arbitrage fund works good for them, So that was kind of a demand also from our investors that have an arbitrage fund for people in the higher tax bracket. So that's that. Also going forward, so one thing is that in the debt mutual fund, the AUM, at least 75% of the AUM is held by corporates, which is less than 3-year money. So it's not too much is changing in that front, There are people obviously will, and again, there's grandfathering. So if you have your asset allocation right, then there's not much to really do. Going forward, incremental money will obviously change from probably pure debt funds to probably a hybrid structure. So I think that's going to be something that fund houses like us who don't like launching too many funds will be forced to launch funds where there's 35 to 65% equity, so we can get the tax benefits, the indexation benefits. So I think going forward, you will see probably a lot of fund houses getting into this space and launching either hybrids or multi-assets, funds. So I think that's probably going to be the future.
So Neil, just to stay with you on this arbitrage point, how close a substitute is an arbitrage fund to a liquid fund? I mean, there are other factors that affect an arbitrage fund also, like the amount of bullishness in the market when the spreads rise or they compress. So what are the risks that investors should be aware of if they are thinking of arbitrage as an alternative?
So arbitrage fund is usually for a shorter duration, so it's not for a very long duration. So on a shorter duration, it really doesn't really affect you that much. So it's not like liquid funds, but yeah, on an average, you'll get something like liquid funds. So, and you get the tax benefits of that too, because you're getting taxed at the equity taxation, not at the debt taxation. So net, I think it comes to around the same thing. It's not, it's probably maybe slightly better than good funds. If on the higher tax bracket.
So Ashish, again coming to your solution, I think White Oak has already a hybrid fund which has a multi-asset fund, I believe. Could you elaborate on that? And is that a solution to the debt fund tax?
Yeah, sure. So Neil, just like we did create a multi-asset fund, and frankly, we filed it and we created it before the tax change. It's just that we were about to launch it, and in between in March, the taxation changed. So that's just a coincidence. In fact, we never created a product thinking about the tax structure, because if you really ask me, I genuinely believe that as the financial literacy improves, as we move to more a middle-class society, successively, I think tax breaks would go out. Because a tax break is a nudge for you as a saver or investor. It's a nudge for you to do the right thing. And if you actually look at it closely, say look at Section 80C, for instance, there's a wide array of investments for which tax breaks are given, which means that they just want you to do the right thing. They're not trying to incentivize any one instrument over the other. It's maybe, sometimes it's just the quirks of the process that some instruments become attractive and less attractive and those kinds of things. But I think over the long period, what we should guide investors is that get over this whole taxation thing and don't use taxation as your main criteria. I think that's a caveat or a disclaimer I would put first. But moving on to what you asked me, see, in our industry itself, multi-asset, multi-asset as a term is a generic term, right? Because what does the regulation say? The regulation says that when you have at least 3 asset classes with at least 10% each, that's called multi-asset. Which means that just like chemistry, you can mix up any number of asset classes in any number of combinations, and it will give you a unique risk return profile for the series of returns. So from our standpoint, what we realized is that, again, our industry is using equity taxation as the threshold for defining what the asset allocation should be. So that's where it all goes wrong, because the moment you say that equity taxation is the threshold for this fund, the defining criteria means it will start with 70% equity. And that's where the concept of multi-asset goes out of the window, because that's where it stops working, So you see a lot of multi-asset presentations which show you a lot of fancy charts about correlation between debt and equity. Those correlations work if you're talking 1 unit of equity with 1 unit of debt, then the correlation data is useful. But the moment you have 7 units of equity and 1 unit of debt, the correlation data is not going to work, right? So that's why we started creating it ground up. Our threshold criteria was that if somebody holds this for 3 years, the standard deviation of rolling returns should appear like a bond fund. And then the return is an outcome, because you control for volatility. See, if I'm looking for a debt substitute, the first thing I should do is control for volatility and then accept whatever return comes out of it as a outcome. And the other important point is that if you want multi-asset to function like multi-asset, where all these correlations of asset classes work, then you should have unfettered, equitable allocation across asset classes. So the way we have devised it is, like equity is 20-30%, global equity is about 10%, gold is unfettered. I mean, on an average, we end up owning 20-25% gold, and then the rest is fixed income. So I think we didn't create it with tax in mind, yeah.
Just to understand this, you haven't even said that equity has to be minimum 35%, because that would put you in the old regime of 20% tax with indexation.
So now, obviously, look, in the best interest of the investors of the fund, since my allocation allows me, it only makes sense that I hold 36% and then calibrate it where the model is telling me to calibrate it. But at least it's not like putting 70% and then calibrating it all the way down to 30% with some 40% in arbitrage. For a multi-asset fund, to do 35-40% arbitrage is suboptimal. So I think at least this works out better, that we hold 36% equity, go for hybrid taxation, and then the calibration is just few percentage points. It's not like half the fund is calibrated down to, reduce equity.
Okay. So Neil, coming back to your conservative hybrid fund, are you thinking of changing the category?
Yeah, so that's a great question. So we run a conservative hybrid fund, which holds, and the definition of conservative hybrid is that you cannot hold more than 25% equity. So even if you hold it for more than 3 years, you're going to be taxed at the full rate, So obviously, one of the things that we've been thinking about is how do we, so again, in the conservative hybrid fund, we have 3 asset classes, similar to like a multi-asset where REITs is one of our asset class, which is 10%. Equity is about 15%, and the rest 75% is in debt. And that we thought was a really good kind of allocation to have, and we didn't want to change too much to that. So one thing we need to do is just make the equity 36%, right? I mean, that's what we need to do. So we were wondering which is the best way to go about it. And multi-asset is something we thought would actually be really good for this kind of an allocation. Unfortunately, in the multi-asset, when we went to look at it, is that they don't allow REITs as an asset class. So we have, as we speak, we've given our representation to SEBI, as well as a representation from AMFI has gone to SEBI to allow REITs and InvITs as an asset class in multi-assets. So we are just waiting on that. I mean, if we had that clarity, we would have probably done it by now.
Sorry, just to understand this better. So it's zero REITs and InvITs in multi-asset.
So the definition of a multi-asset, like Ashish said, is that minimum 10% in each asset class, or at least 3 asset class. So that's the multi-asset definition. But the definition of REIT is that you cannot hold more than 10% REITs in a single scheme. So one is saying minimum, one is saying maximum. So we are trying to get the clarity that can we, in the multi-asset, can this be minimum 10, I mean, can it go above 10%? So that's where the clarity needs to come in.
Right. So because you want to put more than 10%, but if you're okay with less than 10, you could launch.
I can't, because I can't launch the multi-asset if the REITs and InvITs is the definition is maximum 10%. So I have to go a little above 10%.
Right.
For a multi-asset.
Right. So I think this is a broader lacuna actually. This 10% cap is on REITs has stopped REITs from growing much in the MF industry, and in general there are only 3-4 listed REITs. In fact, one exception to all of this is an index fund tracking the REIT index. Have either of you thought about this?
No, I mean, we are pretty much happy being active managers, so stick to that.
Ashish?
I think you're saying an index fund of domestic REITs. I mean, it would be a good concept. I mean, provided, haven't thought about it, no plans to launch, but I think it's a good concept. You know, because see, all said and done, mutual fund investors prefer a mutual fund vehicle. Yeah, because, you know, you can click a button, buy $500, matter ends there. But to access REITs, otherwise you need a broking account and, you know, so many other things. So I'm quite sure that it will take off as a product. I think somebody needs to think about it. And there is merit. The other important point is obviously the depth. I mean, how many instruments are available, you know, because all said and done, you can't just blindly bung in some money into some REITs. You need analysis on that, you know, in terms of, it needs fundamental analysis. But I do concur with what Neil said. You know, I think from a regulation perspective, you know, we need to be clear that REITs and InvITs are a very good hybrid instrument. It's yield-based, but it has price action also, right? So it's a very good hybrid instrument. So I think we need to figure out how it can form a substantial part of any hybrid mutual fund, whether it is multi-asset or balanced or whatever. I mean, it needs a space to be allocated and slotted appropriately. I think that's needed.
Yeah, and let me just add a point on tax. So again, the same budget suddenly complicated life for those who directly hold REITs, because it said that, so REITs pay out money in various forms, dividends, capital gains, and of course something called return of capital, which earlier was exempt, but now there is a very complicated system where you have to calculate how much has been already returned against the face value of the REIT and then figure out your tax, which has made essentially holding directly REITs really, really complex, right?
But Neil, I'll just add to that, right? A lot of our bias comes from the anchoring that we have to the previous tax regime, right? But if you think about REITs, if you think about bonds, like to like, that asset is better held via a mutual fund than via a direct instrument, right? Aside from the fact that there is diversification, there is better diligence, there is a fund management team evaluating and identifying and creating that portfolio, the fact is that in mutual funds you get tax deferment, and that adds value, right? Imagine you're holding a bond or a REIT instrument individually in your own demat account. you get those cash flows, you have to pay taxes, advance taxes and so on it. Whereas if that asset is held via a mutual fund, it's significantly more efficient because I have more money to compound that over a period of time. So everything being equal, if you have an 8% bond and a mutual fund tracking 8%, over a period of 3 years, you'll have almost 5% incremental return just because of this tax deferment structure that mutual funds offer.
Yeah, so let me come to some solutions that exist now, tax efficient solutions. So both Vinita and Sandeep, is NPS a good option? Are there other products other than mutual funds that you can use for direct bond investment?
So I would say before even reaching to NPS, we are all like, even the salaried class, they have the EPF. Then you have the PPF also, which goes on. There are other tax saving products which are already there. Then of course NPS with that 50,000 more per annum is a very, very attractive thing. The only drawback that I feel is that, having that 60% which is tax free that you get as a lump sum and then that 40%. But it has definitely become a very attractive product now that, it is equity linked and people are getting good returns. So again, I feel NPS is still in a stage where they are clarifying products and the guidelines. It is being, when we go to the corporates, it is shown that most of the employees are into that. So it is definitely an alternate.
Neil, again, if you think about it, what is the customer telling us, right? Incremental money is continuing to get allocated to corporate bonds. We've seen SEBI come out with OBBP regulations around this to enable this market. But at the same time, we're seeing money go into lease financing. We're seeing money go into P2P. We've also seen the size of credit AIFs increase dramatically, right? And there are obviously challenges with that, given that you can only put in a minimum of 1 crore. And therefore, there's only so many AIFs that you can deploy capital in. What is the customer really asking for? I think post 2018, the NBFC crisis, we had a situation where we today don't have enough funds investing in true corporate paper, right? And it's not about the tax, it's about...
Sorry, when you say true, do you mean high yield or?
High yield, well diligenced, well researched, and mutual funds are best placed to do this analysis, right? They have the research teams, they're already deploying that on the equity side. They can extend that to the fixed income side and be able to create portfolios which have higher accruals. And honestly, customers will be willing to pay the tax if the risk return profile is attractive. Obviously, there are things like asset liability mismatches and learnings from the previous era that we have to deal with. But I think there is a massive opportunity in that category. And I guess we need to look forward to those mutual funds coming up with those kind of opportunities for us.
Ashish, your take on this. Why aren't credit risk funds taking credit risk?
Yeah, I think, see, it's like this. The learning is that it's best done in a close-ended, gated structure. See, even when the mutual fund episode happened in 2020, the moment the fund was gated and held on, money came back, right? That's what I mean, of course, there must have been some NPA and all happened. But the moment it was gated, so it's the one lesson is that sometimes you have to give up liquidity to preserve capital. That is one lesson out of that whole thing. That is the reason why the action has moved to AIFs, which are say 5 years, close-ended. Communication is not mass retail. Communication is limited to people who supposedly understand the risks. So I think that's the reason why it has moved there. The other important thing is that if you want to do it in a mutual fund, then you need to enable hard lockups or you need to enable steep exit loads or you need to figure out some other ways to do it. But that's not permitted. It's not going to work. Right?
But Ashish, you have closed-ended funds which you can launch today and take credit risk in them.
So if you really ask me, close-ended funds as a category for a variety of reasons is not preferred. Like for example, one of the reasons is that close-ended funds, if I'm not wrong, there is a cap of 125 basis points. You cannot have more than 125 basis points operating expense in a close-ended fund. And I don't know if it is only equity or equity and debt, but I'm quite sure that the cap is 125 bips. If I'm not wrong, debt might be lower actually. Okay, so I think there is that challenge also. And the other important thing is that when it comes to retail mutual funds, one of the key features of a retail mutual fund is that the liquidity it gives. So if I'm going to say that, yeah, okay, this can potentially give you 150 or 100 basis points more, but forget about your money for 5 years, then that's the other angle which comes in, right? But I think the long and short of it is that you should not do it in something which gives 24-hour liquidity. Because, every once in 5-7 years, some accident tends to happen.
Sandeep, can you talk about what's happening with HNIs? What are the new exotic products that are now entering the market given this debt fund tax?
So like I said, HNIs will primarily deploy capital into regulated assets, and the credit funds or the credit AIFs have scaled dramatically. We've seen over the last 6 to 8 months, significant capital or commitments flow into this asset class. There's obviously concern among HNIs that is there enough high quality deal flow to be able to absorb this kind of liquidity, and what will that mean for the kind of yields that get locked in on these kind of assets, right? So if a lot of money is chasing a few high quality deals, then and the yields go down, is that then attractive enough from a risk return profile? So I think that is the challenge, but having said which, a lot of money has gone into individual bonds. Mint wrote about it today in some individual instruments which have sort of caught the fancy of the market. I think there is, and they are willing to, by the way, lock in capital also. So to that extent, if there were gated products where there is ability to put that money aside, I think allocators like us will be willing to take it to the market.
Fair enough. But apart from AIFs, so AIFs is one, are MLDs over because of the tax? Are there, you talk about invoice discounting, and all of this is, a lot of this is unregulated, right? So invoice discounting, etc. What is the future for India's investors in debt?
Look, see, again, MLDs by themselves are not bad instruments, right? They are instruments which give you some sort of fixed income nature with equity upside. So in themselves, there is nothing wrong with MLDs. The question, however, is how do folks like us take it to the market? Are we communicating things correctly, and are we educating the customer before they invest into that asset? So I think that therein lies the responsibility. We need to tell customers about the fact that there is credit risk that they are taking in these kind of assets, that the fact that, again, liquidity is not easily available. I think there is space for these kind of structured products in the regulated domain, provided we back that up with education.
Vinita, is small savings an option for, especially for retail investors? Will they make a comeback?
Sorry.
Small savings, like you had mentioned PPF, you had mentioned Employees Provident Fund, all of that.
Yeah. So that is going to continue even with the new tax structure. I feel EPF is a very good option. PPF, people who are not salaried are into that. Of course, there is ELSS, which, we try and make, you educate the crowd about that, because very honestly, very few people, when they just get into the job structure, know still about mutual fund and the equity as a investment option. There are still people who come with, real estate and having, getting into housing and things like that. Their first goal becomes that. So getting them into the education stream, about all the nuances about each of these products is still a very attractive option, because all said and done, the small savings over, the time, because of the lock-in periods, does give a good corpus at the end. So it is there from my side.
Okay. So we have 9 minutes left. What I'll do is I'll invite questions for the next 5 minutes, and then we'll go back to the panel for their closing remarks. So if you can pass the mic around, and feel free to raise your hand. Can we have the mic passed around? And it doesn't have to be a question. So if you yourself are a wealth manager or distributor, what solution are you offering to your clients? We are interested to know. How do you approach it as an investor? How do you approach your own money, your fresh money that's coming in? Are you still putting it into debt funds? Are you going for hybrid funds? Are you looking at some of the sort of high yield AIFs, MLDs? Are we?
Any questions? Yes? All right, I'm going to come to you with the mic.
Hi, this is Lalit. I'm a distributor. I wanted to know, like, instead of offering any liquid products other than ultra short term and maximum to ultra short term, then going above that for the medium term bond or any other bond, don't you think asset allocator funds will do better in terms of what you get in return? Maybe 3 to 4 years of holding and you have very less equity in that. So asset allocators will serve the purpose. Then why to have any debt product beyond ultra short term fund with respect to the time horizon I'm talking about?
Yeah, that's a very interesting point. And we had actually done a story on this, that if you take rolling 3-year rolling returns of hybrid funds, despite equity being in there, they tend to outperform debt funds. There is more risk, but equity does well on the long term.
Actually, Neil, what I've seen is that the understanding of asset allocation and studying correlations, that understanding is not there. See, I'll give you an example. Let us say you make a, there's the efficient frontier is what you're trying to find out with a risk return plot, right? So let's say if I tell you that you're holding a bond fund for 1 year, it gives you a return profile that's 7.5% average and a standard deviation of say 7. Now the question is, if I add 10% equity to this, what should happen to the risk and return? The standard answer will be because of equity, the volatility will go up. But if you keep increasing and if you keep playing with the allocations, you will hit a certain point where the return will, per unit of risk, the return will go up. You can even have, so if you add on debt, you load gold, on debt you load equity, and then you load gold. Basic point is you will arrive at certain allocations where the return will go up, but the risk won't go up much. I think currently that understanding of how asset allocation and how correlations work for varying combinations, that understanding is weak. So if you ask anybody, what happens if you add equity to debt? The standard answer is it becomes more risky. But no, you have to figure out at what level it works optimally.
Or at what holding period?
Which holding period and what percentage allocation it holds, it works optimally. I think that understanding needs to come about. So he's right that for so many of the time horizons, instead of debt, if you mix up asset classes, you might do better. That's one. And second is, again, I don't want to bank on tax structures to build products, but the quirk of the current taxation is that if you have 36% equity, then the balance 64% can be debt, equity, international, whatever it is, all of that comes into the lower tax slab, right? So it even furthermore makes sense to invest with these kind of asset allocated or hybrid kind of products in the current regime.
I'll just add to the point that Ashish was making that, yeah, over a long period of time, and it's advisable to have those kind of instruments. The challenge that we face is that the non-linearity of returns, right? That in the interim, sometimes you might be worse off. And if the customer or the investor exits at that point, you're doing their portfolio and your relationship with them a disservice, right? So that's the ongoing challenge that we have with multi-asset funds, where the customer is, especially if it's not been communicated correctly, they are coming in with the expectation of better than fixed income returns. But in the short term, if they lose some money, they are naturally concerned and therefore they want to exit. And they're breaking that compounding which this asset would have delivered to them.
Yeah. In fact, sorry, another question there. I'll just come to you, Deepak. But before that, I want to point out one more anomaly that's happened with this tax change on debt funds, which is that overseas feeder funds, which are taxed as debt funds, again, no matter how long you hold them, you will always be taxed at slab rate. But if you hold the same ETFs, the same stocks through LRS, you get the benefit of 20% with indexation. Again, I don't think the government had that in mind, but that has been the result of this tax change. Can we go to Deepak?
Yeah, so I have a mic. So question to Sandeep and Ashish both. Now, when he's saying that I'm putting my client's money in a short-term debt fund, the idea is allocation, that I will be needing this money anytime in the next 2, 3, 6, 8, 10 months. adding another layer of an asset class may increase returns if he is trying to hold it beyond 3 years. No?
Only long term. Yeah.
That is the idea. So what happens is, again, these multi-asset funds are a bull market phenomenon, because you are taking the equity returns of the past 6 months, 1 year, and adding it onto those returns and showing that a multi-asset fund is a better fund. A debt fund is a debt fund. I want to preserve my capital. I am happy not paying quarterly, TDS in a bank FD. That is why I want to come into a short-term debt fund. So if that is asset allocation, then a debt fund should not be compared with a multi-asset fund. Both your views.
No, absolutely. I think the tenure has to be got right? And I think we can't see a lot of fund selection also happens on basis of recent performance or past performance, right? And I think that's where maybe allocators like us get it wrong when it's some sort of like easier way of offering products, right? When you show recent performance. I think that's definitely not the idea. And getting the tenure right is also very critical. The point I think I was making was that if the tenure is long, let's say 3 or 5 years, within that time frame, on paper, multi-asset funds likely to do better than short-term funds. The only point is that the customer or the investor should be able to live that journey, which often doesn't happen.
Also, when you're having a multi-asset or a hybrid kind of a fund, I think even the equity part can have more arbitrage in that. So it's more of a debt profile than actual long-only equity. So I think we can make products where it's debt-like, but with good taxation, and you're getting your debt-like returns.
The problem is, again, all three of you. So what happens is a customer runs away from an equity during a bad market. And if you have a product which was positioned as a debt fund which had actually equity in it, that exasperates the problem. In March 2020, if I had a debt fund which was giving me 6% returns, I would have done nothing to it. But if there was 20 or 30% equity in that, my returns could have gone to zero effectively, right?
Yeah, no, so you're right. Time horizon cannot be compromised. So that's very clear, no doubt about it.
Okay, we had a couple more questions.
Considering how nascent REITs are, any kind of time period or any kind of specific gauges when it becomes an asset class firstly, as you mentioned, and it achieves some kind of buoyancy or dynamism. Going down the road.
See, I think that it's an asset class which is less understood right now.
Right.
Correct. And obviously, because it's a hybrid, it's not like you're owning commercial property and just getting lease rental. The fact is that there is tenancy and occupancy out there. The fact is that with changes in interest rates, the expected yields will change. The fact is that underlying real estate prices could change and there could be economic cycles. So it's to be seen as a hybrid, right? And to that extent, of course, it is risky. It's not, again, that is not something which is just a direct replica for fixed income. So it needs underlying analysis, it needs advice, and you need to be in some and you may not want to be in some, right? So it needs, like a longish time frame. I would say at least 3 years to 5 years. After all the analysis,
Right.
It's a risky product.
Right. So I don't know if everyone here is aware, but SEBI has floated a discussion paper on something called MSM REITs, medium, small, micro REITs, which will, if implemented, it will lower the minimum threshold for REITs from the current, I believe, 200 crores to 25 crores. And it doesn't say that it has to be commercial property, which opens the door to residential property. I'm very positive on this circular because, Indians, we are quite well disposed to residential property. And this was already being done in an unregulated manner through fractional investing platforms. So this will come into the light, so to speak. It will be regulated. And it will, just think of the number of new REITs that could come into the market that could transform our investing journey. Maybe we can take, okay, it says time's up. Maybe one last question and then we'll sum up.
I think what you said on REITs and the MSME REITs, and I think the beauty is that if you see from an economy or a capital market perspective, it makes your entire capital stock more productive. Because it's more efficient usage. So I think it would actually it would have the impact of increasing productivity in the economy itself. Because there's no asset which is dead asset, that asset is again being recycled.
Yeah, fully agreed. Okay, one last question and then we'll ask the panel to sum up. All right. So if we could, go ahead, Satya.
Hi, thank you so much. I'm Satya and I'm in the education space of financial education for investors. My doubt is with the debt taxation making it not so attractive for investors, will endowment plans and money back plans which are offering guaranteed returns and that too which are tax free, maturity benefits are tax free, will they come into picture again? I'm worried that comes into picture because the term cover that it offers is much, much lower than what the term cover offers. So what are your views on that?
So before you answer, so Satya is a former colleague of ours. I'm sure many of you have read her byline. She's written some of our best stories. She's now with the country's largest broker and she runs financial education for them. So Sandeep, can...
Yeah, I think it's, we operate in the SEBI domain. So look, I think the fact is that these have much longer tenures, right? And that's something that as again allocators of capital who want to be able to efficiently move money around, we are not able to get our head around that. So we have not recommended these to investors for just the reason that liquidity is not easily available and I can't offer liquidity to the customer if they need money around it. I think as IRDA builds regulations around this, maybe we'll have more clarity, but I'm personally not super excited about these assets.
Vinita?
Yeah, so just adding on to the points he's already spoken about, the tenure, the lock-in period, the liquidity. We have to understand that the debt funds are there for a certain reason, that they need short-term, you have certain goals and you need to liquidate them. So that, I don't think that can be taken away just because of that tax system that has come into force. It still remains and it is still got a lot of positives and is a product that people would be investing in. Not ULIP, no, I don't think so that's going to happen.
Yeah, I mean, God forbid that this country has to meet its fixed income needs through insurance. Probably the last thing we want. Okay, can we have a sum up, Ashish, and then we move this way?
No, I think since there are not too many questions, I think I should compliment you, right, for having like a very comprehensive discussions, So thanks a lot for having us here. I think my takeaways are only two things. I think one is that, because, I mean, ideally taxation should not be your driving force, right? You need to evaluate products on their own. And second is better understanding of how different asset classes work so that you can make the right combinations. I think these are things which are like more food for thought.
Yeah, so I think similar to Ashish is that have an asset allocation, don't think too much about taxation as such and make your decisions on that. But secondly also that one thing we didn't discuss is that debt funds are still better compared to FDs. I mean, if you're going to do like-to-like comparison, debt funds are still better than FDs and it can be a part of people's portfolio is because it gives on-tap liquidity, they're open-ended and taxation is on, you can defer your taxation when you sell your products. It's not like FDs, you get taxed on a yearly basis. So it's not as bad as it seems. So I think debt funds still have a place in people's portfolios.
Yeah, and there's also capital gains set off and carry forward, which you can...
Exactly.
Vinita?
Thanks for first getting us here. And then I totally agree with Mr. Anand saying that education is extremely important and being at that root level there, we actually know that people have no idea about investments and linking it to goals and the nuances of different products. So if we do actually need to make that 10 crore to 20 crore, there is this huge gap that, we need to educate people of. I mean, we are in good times, but education is a thing that, needs to be really focused upon and the growth needs to be there because of that.
Sandeep?
So compliments, first of all, Neil, to the team at Mint for all the work on financial education and evangelizing mutual funds especially. Two big takeaways for me, multi-asset funds have a place in the portfolio. and as allocators, we should take them to clients. The second is that there is a space for accrual, high-yielding instruments on the fixed income side with the right checks and balances to ensure there's no run on the bank. But I think we as allocators, we would love to have more of those products also to be able to create multi-asset portfolios at our end.
Great. So just one takeaway that I want to emphasize as I sum up, which is that the tax system will always keep changing. It will keep throwing up surprises, more negative than positive. But we have a great industry that will come up with solutions as they have said here. And for those of you who are in the distribution space, in the advisory space, the task then begins of communicating those solutions to your clients. So great. Thank you so much, everyone.
Thank you. Can we have a huge round of applause for Neil? Neil, clearly you're a man of few words, but you can make others talk and talk really well. Thank you for asking very pertinent questions on behalf of all of us. I'm going to request the panel to please step forward, step a little forward. Cool shoes. Okay, come on. Let's take a quick group photograph and a huge round of applause, ladies and gentlemen. A lot of food for thought coming from our first power panel. Now for the next 1 minute, this stage is definitely going to witness a lot of conversations, but we want to, for the next 1 minute, take this conversation from talking about it from the outside perspective, which is as mutual fund managers, bringing it to the inside perspective. Please stay tuned to your chairs. We're not breaking as of now. We're going to move forward and invite our next speaker while we set the stage. All right, so quickly, give me a couple of seconds before I introduce our next speaker, who is actually here to throw light on the next 40 trillion. This is, pretty much the tone on which we started with our first conversation. Now, in this rapidly evolving financial landscape, I think our next speaker is here to kind of promise us to unveil strategies and even paradigms that are going to reshape some emerging concepts, that will possibly be guiding stars of investments, and hopefully, but certainly, actually, he's going to give us a value proposition that kind of redefines the way we look at the mutual fund world. So the stage is set for him. Please join me in welcoming our next speaker onto the stage. Chief Investment Officer, Axis Mutual Fund. It is Mr. Ashish Gupta. Can I have a louder round of applause, everybody? Come on. Mr. Gupta, welcome. Thank you for joining us.
Good evening. First of all, thank you to Mint for inviting me and bringing together such a esteemed gathering. So the topic I was given was the next 40 trillion, right? And I guess the genesis is that the industry has grown to about 46 lakh crores, 46 trillion rupees in AUM. If I looked at history in 2000, this number was just about 1 lakh crores, right? And roughly the industry over this 20-year period has doubled in AUM every 5 years or so. If I look at the last few years, in fact, this journey has been quicker. In less than 4 years, the industry AUM has doubled. So I think the question that comes, the next 40 trillion, when will it happen? I think the answer is fairly simple. It will happen in the next 5 years. We know India's nominal GDP grows at double-digit rate. On top of that, Anand spoke about the fact that there is more financialization of savings. So savings are growing faster than GDP. Financial savings are growing better than savings rate. So I don't think unless we as an industry do something drastically wrong, the trend in the next 5 years should be much different from what we have seen over the past 2 decades. So maybe it's in next 4 years, maybe it's next 6 years. sometime during that time frame, we will see the move forward to the next 40 trillion. But I think more than AUM, yeah. So more than the growth in AUM, I would like to highlight some other trends which I think make the journey a lot more interesting. I think Neil spoke about we as responsible participants of the economy and the financial ecosystem, right? So this is what I call some pointers to democratization of mutual funds, right? 5 years ago, there were less than 2 crore individual investors. I'm not talking about folios, I'm talking about investors. Today, this number is close to about 4 crores, right? If I look in terms of number of income tax filers, because as you know, all of us mutual fund industry operates with the anchoring of PAN number. So we have moved from about 31% of PAN holder penetration to about 51% of PAN holder penetration. Another encouraging trend is the number of women investing. So that number has also doubled. That number is close to 75 lakh women investors. And equally interesting is that it is no longer dominated by just top 5 metros. So just 5 years ago, about 2/3 of the industry AUM was emanating from the top 5 metros. Outside top 5 contribution is now close to half for the industry. I think Anant has left, but I think one thing he spoke about was the responsibility of the industry in terms of selling the products wisely, responsibly. I think one of the observations I have, and frankly, I have come into the industry only 6 months ago. I had the outside view for the last 28 years. So my inside out view now is actually very different. I think mutual fund industry in India has evolved from being an investment industry to an asset allocation industry, right? 75% of inflows that have happened into the mutual fund in the last 2 years have come through the most popular SIPs. In the last 6 months, as I have in the new role gone out, met various investment advisors, I'm actually amazed by the fact that when anyone introduces himself, he says, I'm so-and-so, I'm Sandeep Jain, I manage 600 crores of AUM. So the only thing they mention in their introduction is not that I sold 200 crores of mutual funds or 50 crores of mutual fund, they just mention their AUM. I think the regulator has also contributed to this with the fact that commissions are now more and more paid on a trail basis rather than upfronting of commission. So the entire industry has moved to AUM in terms of selling. I have met distributors, investment advisors who have now got their children into their business, right? Because they actually see that this is not an annuity, it's a perpetuity, right? And I think really my personal belief is, and I'm sure people have different views, that I think with this shift, the risk of mis-selling in this industry has drastically reduced because none of the distributors wants to let go of a client, right? Most of the distributors, when they advise a client, they don't advise buy X mutual fund or Y mutual fund. They just say, you start a SIP in this mutual fund. And as the panel before also talked about, that if you have duration in your equity investment, the probability of poor experience really comes down. And I think the distributors understand that because they are now actually not looking to sell a mutual fund, but they are actually interested in building a perpetuity for their, not just their clients, but for their family. Another important aspect is that direct funds now contribute 20% of the fund. Passive share has increased to about 17%. And I think one thing that needs to change and further enhance this experience, and I think the trends of last 2 years of sales coming through SIPs, is that the tenor of investments of investors needs to go up. So currently, the average tenor is still only about 2 years. But as I see the persistency itself in SIPs, and we have some SIPs persisting for 4-5 years, I think increasing tenor will also enhance the return of investors from the mutual funds. The last aspect I think I would like to touch upon is that what is the value proposition of funds, right? And I want to kind of take 2 vantage points for this. What is the value proposition for the investors? What is the value proposition of mutual funds as a player or the financial intermediary in the ecosystem? If I look at really from the investor point of view, I think we have enough data that has consistently come through, whether you look at 10-year, 15-year, 20-year, what the returns has generated, particularly on the equity fund side. On the debt side, yes, now returns, as the previous panel talked about, there are, but I think the point came across that compared to other fixed income instruments, there are still advantages. I think Sandeep spoke about the fact that how deferment of tax increases or enhances return to investors. There are probably there's a debate of active versus passive funds. I talked about the fact that today less than 20% of industry in India is at passive funds. Globally, this number is getting close to about 50%. Maybe this trend in India will also continue in that direction. But at least we as active are happy to report that we are still generating alpha. So if I look 3, 5, 10-year track record, the degree of alpha generation has come down. And in fact, that is why there's no surprise there is increasing amount of flow to other categories. I still think that mutual funds offer a compelling value proposition to investors. But not just investors, I wanted to actually probably less appreciated is what mutual funds do as a financial intermediary. And Neil, to your point that how are the pipes, right? So we are the pipe in the ecosystem. We are funneling money from the household sector to the corporate sector as well, right? And there, I believe, actually mutual funds are the most efficient financial intermediary. If I look at the difference between what is the return provided to investor versus what is the return generated, right? Mutual funds, the average cost is only about 1.4%. The differential between these two is only about 1.4%. Government bonds at 6-7%, they keep cash. Still their average yield on the book is close to 7.5-8%, while what they on average pay to depositors is less than 5%. So the intermediation cost of banks is close to 400 basis points. If I for the insurance industry, the cost is actually similar, and in many kind of products, it is even higher, where the industry kind of generates a return of between 7 to 9%, and actually the return, or at least the financial return to policyholders is sub 3%. Of course, there is another service they provide, right? Even if we look at a conservative 2:1 debt equity financing, that will mean that equity capital or this capital that where the mutual fund industry is doing. I totally agree. This capital to the ecosystem, it is going into the safest asset classes. But if I look on the equity side, I think really the mutual fund industry is the key provider of this capital, beside, of course, the promoters as well as companies' own cash flows or internal accruals. If I look at the IPOs that have happened over the past 2 years, nearly half of that was raised by these companies ultimately ended up coming from the mutual fund industry, right? We talk about the fact that there is a great and thriving startup ecosystem, venture capital ecosystem, private equity ecosystem. But if you look at data, ultimately all that ecosystem again needs capital from the public market, and really the biggest provider when summarizing with these 2.1, mutual fund industry is probably one of the most efficient intermediary in the ecosystem. Secondly, it is also one of the key provider of this capital into the ecosystem. Thank you.
Thank you very much for that address, Mr. Gupta. I think that presentation that you made was actually possibly a very, very encouraging one. So thank you for that. Well, ladies and gentlemen, I'd like to take the next couple of you once again to join on the conversation or online. And please make sure that you use hashtag MintMFC2023 when you share your thoughts, your quotes, or any takeaways from everything that's happening in this room. And don't forget to tag us at Live Mint. We also want to give another huge shout out to our partners, Axis Mutual Fund, Bandhan Mutual Fund, Baroda BNP Paribas Mutual Fund, ICICI Prudential Mutual Fund. Mirai and we are curating events that help us to think ahead. Your feedback is extremely crucial. So very, very shortly, we, of course, we'll throw up a QR code on screen so that you can capture that, and that would possibly take you to the feedback form. And we need your absolutely, clear and honest feedback so that the next time we meet in this room, the next conclave, the next meeting, community meeting, can only be bigger and better. So, as you gather your thoughts, also gather enough feedback in your mind so that we can take it back home today. Okay, so our next speaker for today is someone we're going to find out through his next presentation. Please join me in welcoming on stage CEO and Director, Mirai Asset Investment Managers India Private Limited, Mr. Swaroop Mohante.
Team said that, you have to thrive in a bull, bear, and sideways market. And our answer to that is you can only thrive and survive if you sort of change constantly. Not only change, you'll have to sort of evolve, because there's you and there is the environment. And this is saying that if your environment is moving faster than you, then you already stand disrupted. You have to at least be in line with the environment, if not ahead of it. If you are ahead of the environment, then you disrupt the environment. So let's look at the environment and reflect on how it is positioned now and how possibly it can change in the next 5-10 years for sure. Now, when I put up my slides, I don't want to go in the reason as an industry today, and we are just getting warmed up when we look at how we are positioned today, because when you look at us as a country, we are a large country, 142 crore people, 136 Aadhaar cards already issued. We are the only country biometrically identified across the world. Adult population of 93 crores, bank account holders of 82 crores, PAN card holders of 60. Anybody who's eligible to mutual fund investors here, out of all this, we just have 3.5 crore unique mutual fund folios. And let me split that part of 3.5 crores folios. Till COVID, that is almost 20-25% of 20-25 years of the industry, we had 2.3 crore folios, or nearly 2.5 crore folios. 1 year post-COVID, we added 1 crore. That's the underlying change which I want you to keep in mind as we unfold into the story. Let me just give you two cliched slides of our industry, and I'm just saying this for the sake of reputation, because these two slides need to be internalized completely if we have to unfold in our journey from 15% AUM to GDP to possibly double that. Let's start with doubling that, and then we'll talk about possibly 75, 80 at some point of time. The question we ask everybody is, what is on your mind? 65,000 Sensex, or this story progressing to the third largest economy in the world? Because whether you like it or not, this is going to the third largest economy of the world. What is also happening post that is very simple. Another cliched slide of the industry. And just to remind you that this is the only country which is giving you this great advantage of doubling its economy in the next 8 to 10 years. That's where we stand today. And of course, I'm hinting to somebody else, I'll come to that. But when you look at the India growth in the next possible 1 or 2 years, it's probably the first time in my presenting career of 20, 25 years that I'm seeing an India growth beginning to impact global growth. So we are no longer an insignificant country. I think Mr. Anant Narayan sort of talked about how global investors are warmed up to India. You have no idea how our Koreans are warmed up to India. There's so much of enthusiasm outside India about India, and at that time, I feel that maybe we are not as buoyant as others are. But this is the story of India. And when you look at the underlying of India, it is no longer just a service-related, one-sided story. It is beginning to look like a broad-based story. I mean, Vetri is here. He will agree with me when I say this, that when you look at data points across, and then there's some data points which I put up, but add to that roads being built, airports being built, medical insurance across the country growing, any data point that you take up, month on month or quarter on quarter, we are only seeing addition. Maybe 2 years ago, with a COVID at the backdrop, we could have said that the base was low, but the base is no longer low, but the data points seem to be sort of piling up by the month. Now, we've also absorbed a lot of shocks as we speak. You know, not a single car is packed at home with 100 rupees of petrol going out of our pocket. We have absorbed the inflation as we speak. We talk about tomato prices and all, but nobody is not buying tomatoes. Life goes on, and we sort of imbibe that in our lives and then go forward. And that is what is happening at the underlying. And they make no mistake on that this is only going to go further from here. It's not going to stop. Why I'm saying this is when I look at the underlying mutual fund data, the mutual fund data does not seem to be believing it. I mean, at a time when all of us know that this is going to go from 3 trillion to 6 trillion, we are redeeming money like there's no tomorrow. Think of the data. That's why I say that we need to internalize this data completely to actually realize the story of India. And that's what needs to be done if we have to progress further. What it will all do is it will just make us richer, and that's what is happening to India. You know, slowly but surely, mutual funds are beginning to get some money from people and reflect on the story that's 1 trillion to 2 trillion to 3 trillion to 6 trillion. If we break that up into pockets of 10 trillion money coming into India, our mutual funds, the number of years it's taking is only shortening. The last 10 trillion came in just 2 years. Take this forward to the SIP data. Against a backdrop of 2.3 crore folios, or almost 3 crore folios now, SIPs have 6 crore SIP. That means number of investors investing in number of multiple mutual funds is far higher. And let's look at the SIP investor. That person is standing put. The same person is behaving differently when it comes to investing in a lump sum manner, where there is blatant return chasing and there is blatant market timing. And I'm talking about the equity side. While on the SIP side, the person continues to participate month on month. While, correct me if I'm wrong, the person will say, oh, your fund has not performed well, I'm redeeming. The same person would be carrying on their SIP in that particular fund. Reflect on it some point of time. And that is what is changing. It is the first product from our side which has got commoditized, and that's why probably it's growing by the month. Right? People say, sip karo mast raho. Nobody says ki SIP ka return itna hai. How many of you actually know what your SIP is yielding? Think about it. the sooner a product gets commoditized, that is when it starts expanding. And that's why probably we are seeing this explosion month on month on this account. But here's the story of India. India still remains a very conservative investor. 50% of our money is in gold. Post-demon, almost 15% of our money is in cash at home. And mutual funds get 4.7% of your money. Post-demon, there is 3 times the amount of cash in your houses than we are getting in mutual funds. Out of 10 rupees that is going into bank FDs, 1 rupee comes to SIP. That's the underlying. Yeah. When you look at the country, and this is our country which was at 2005, it was a low and middle income country. You know, when I went to make my suit, and I can't forget this example, and I was telling Master Ji ki yes, thoda पेट बड़ा है, आप उसका थोड़ा ध्यान रखना. He said, ये आपका problem नहीं है, पूरा country का problem है. And we Master Jis know how to, tailor a suit, but that's the India story. पेट थोड़ा बढ़ता है. And when पेट बढ़ता है, the lower and the upper middle class start growing. That is where we are. Look at the money flow in between 2005 and 2018. We are getting a serious low and middle level consumer then. And what will happen to the 2030 sort of forecast is slowly but surely, the upper middle class and the higher class will start to become a real story in India. India will start amassing wealth, and that wealth needs to be deployed. And when you look at the distribution landscape of the country, it can be divided into 3 lines. When you look at the lower and middle level part of the industry, that's where probably the digital players come in. I'm just making a sort of projection. I can be wrong. The upper and middle class is open to all levels of distribution, and slowly but surely the higher level will move into private banking. But when you look at the data points that are unfolding, the simple point I'm making is there is space for everybody and more. That is why we feel there is a long, long way to go when you look at the Indian financial investing perspective. But finally, what will make a product explode? What will make a product acceptable? It is the experience of the product. Why do you think there are more SIP investors coming in than, say, the lump sum investors? Because the SIP investor is actually participating. That's his or her main outlook. And when you look at participating over a period of time, whether you look at buying a house, you don't have to convince somebody to buy a house. You don't have to convince somebody to buy gold. And actually, if you look at India, on Akshaya Tritiya, when we buy gold, it's the most expensive price. But the experience has been so good over a period of time that they want to participate more than knowing what is else. So when you look at this story unfolding in the next 5-10 years, we feel, and when I say this, I'm saying this more from a number of investors' perspective rather than, say, the AUM perspective, the first level of investors will come in to own the benchmark. When you look at 15% GDP versus 75-80% GDP, bulk of the investors lie at the bottom of the pyramid, and that is market participation. Reflect on this when the behavior of SIP is involved, and going forward, we are already seeing market participation happening at a benchmark level. From there, the person will graduate into rule-based and expertise. And we are seeing what has happened in the last 5-7 years when it comes to categories like BAF. We had a long discussion on multi-assets. So these are asset classes or categories which will start getting more and more money. And then, after all this, they will move to the human expertise, which is pure active management. Again, this is not a reflection of the amount of money that we'll manage. When you look at the wealth, probably the amount of money managed will be at the highest end. But the number of investors probably to start with will be more at the bottom, and that is beginning to happen in the industry already. Short period of time between 2019 to 2023, what used to be just 2.8% of industry folios in the form of passives, today is around 14% of the industry already. And passive is still not a story in India. India still remains a very active story. there are enough managers which will come and give you benchmark beating returns is a fact. But the thing is about participation. The thing is about, experiencing the asset class. Hence, what will happen at that blue level, it will just start growing from here on. And it's great that they come in and participate, and once they start participating, we can then push them up through that experience into other modes of investing. But that blue line is only going to expand, and that is how globally AUM to GDP starts growing. Let me tell you, Mira Asset, we work in 17 countries. India is the only country which is selling active. That's the global landscape, right? The active is making a comeback in the passive industry in the form of active ETFs. It's making a very decent comeback, but again, at a participative level. It will expand those investors there. That is how this will start growing, and make no mistake on that. But here's the good and bad part. When you look at India, and you look at India from the data point of 60% of world population under 30 being in this country, very slowly but surely the demography of investors is already happening. 25 years, 2.3 crore investors, 1 year, 1 crore investors, next year 70 lakh investors. So in the next 3 years, we will put more investors in mutual funds than it did in the first 25 years. And when you look at this new set of investors coming, they're either the millennials or the Gen Z. You know who the millennials are and who the Gen Zs are. I don't need to sort of explain to them. But when you look at their behavior, they are not behaving very differently. When 100 people were asked by YouGov, 57 said that they will still put their money in savings account. 54 of Gen Z said they are in savings account. Incidentally, the millennials are more tuned to mutual fund than the Gen Z. The Gen Z is actually more towards gold and precious metals and cryptos. So we as mutual funds have to work really hard to convince the Gen Z to come our way. When you look at the millennials, 50% of people who were born later are actually warming up to mutual funds, not the ones which were born earlier. So from a communication perspective, from convincing the young, we still have a long way to go in telling them that this is a good product and they need to participate. That's the story. So the work for us is actually very, very hard. So what do we need to do? I'm almost up for time, so I'll just finish up quickly, is that, finally this is a business of trust. And they will come to us if they trust us. That's the truth. They trust the asset class they invest in. They trust gold, they trust banks, they trust their houses, so they are there. First, we have to build a business of trust. Please understand, this is a fiduciary business. And I hope Mr. Anantanaran was there, and I would like to tell everybody there are just two people in this room. The lawmaker, which he was, he is, and the law follower, which we are. There is no third person in this business. It is somebody else's money that we manage. More often than not, I hear, kuch rasta nikalo na. There is no rasta. Till the time there is some jugaad, there is some rasta, that trust will not happen. We have to clean up our act and come across as a clean safeguard of the other person's money. Only then will we regain absolute trust. And that has to happen over a significant period of time. This is very fortunate to be in a fiduciary role. Not many of us get to manage somebody else's money. If I ask you in this table, on this room, what is more important, your health or your wealth? You'll put up your hand and say, yes, health is important. In your mind, it will be wealth. Trust me on that one. Yeah, but we are very so fortunate to be on that side of the story, so we have to uphold that. There is only one rule in this business, and that is what is right for the investor is right for us. There is nothing else. And then, while the globe has moved on and started investing in other parts, I think India still is a market cap investor. Our portfolio is finished with large cap, mid cap, small cap. I'd just like to leave you with one small example, is that if you look at a flexi cap or the category of flexi cap, the 10-year return is 15.74. If you look at consumption, I could have gone on, but let me just give you one example. The consumption category has given 15.76. And as a homework, I'd like all of you to go and see the standard deviation of the consumption fund category. It has given superior risk-reward return over a 10-year. But when we look at thematic investing, it is immediately confused as sector investing. The world does not invest in market cap. World has moved on into thematic and new ideas. And with passives, let me tell you, that's just going to happen, because what's happened on the active side is categorization has killed ideation, whether one likes it or not. On the passive side, wherever there is an investable universe, you can create an index, and through factors of that index, one can give you multiple stories. And that will be a big attraction going forward, not taking away anything from the active fund management space. But if we have to go ahead and beat the disruption, our minds have to open up to new ideas of investing, because the young are very different. They are open to new ideas. I think Varun is here, and Varun and I shared a very interesting story on Fang Plus. We were surprised to see the number of young wanting to own Fang Plus. And today on a daily basis, our Fang Plus organically does around 4 to 5 crore organic volumes without any advertising. We can't advertise because we just have 100 crores to take, right? But it organically appeals to the young, and it just goes on trading on it. We're not advertising at all, because the moment we advertise, the fund will stop because it reaches its limits. The young are wanting something else, and we have to give that something else is a reality. So how are we preparing? I just wanted to take our example to give of what we look at it. We've evolved over this period from being a classic, long-only active manager to having different businesses catering to different investor classes. We now have the broking business, we have the index business, we have the financial services giving loan against mutual fund, we have now the passive side of the business across spectrum, trying to give a product to anybody who matches. Please understand, we are a product manufacturer. We are agnostic of your choice. The investor chooses what he or she wants. I should not be biased in any way. I should be standing here unbiased in front of you, giving you a good product which you can catch across the length and breadth. That's what we want to do, and I just wanted to replicate ourselves as a solution, is that we want to be a well-diversified fund house, trying to give every product that we can, which we can manage. Widespread product basket from the liquid fund to a risky Fang Plus. I shouldn't be judging what you want. You should judge what you want and cater to what is good for your portfolio. It's a business of people, whether on our side or partners. Build good partnerships and build a good ecosystem to give a good solution. Lastly, good innovative ideas to catch the fancy of people. My biggest worry is my son is 24 years old. He stands up and says, "Dad, you don't have a single product for me." That's my biggest worry, because that's the age of the future. And who am I to judge? They are economically better, knowledge-wise better than me, and they will judge, trust me. If we don't give new ideas, they will shift somewhere else. But at the end, thank you so much for 15 years with us. We've spent 15 years in this country. This is a big moment for us. We stand in front of you as the only organic global asset manager here, and 15 years in India as a global asset manager has not been an easy journey. So thank you so much for your patience listening, and thank you so much for your time, and more important, trusting us for 15 years. We're trying to build a business of trust. We just got started, build a platform. We have a long way to go. Like the industry, we would like to participate in the industry along with investors. So thank you so much for listening to me. Really appreciate it.
Thank you, Mr. Monty. Wow. What an absolutely incredible presentation. Please take a seat and enjoy the rest of the evening. I must say you've earned it. But, through not just facts and figures on screen, but I think the twist with which you presented them to us has really made all of us in the room think as one community. All right, ladies and gentlemen, here's what we're going to do, which we were supposed to do a couple of minutes ago, but as the stage is being set, we're going to shift the conversation from this side of the room to that side of the room, all right? So because, almost every speaker so far has spoken about how trust is the bedrock of, success and power in this industry. You'll agree with me when I say that trust begins by trusting, each and every person in this room. So what I want you to do next is, first of all, pick a partner. Pick a partner. Could be the person sitting right next to you, left or right. Just pick a partner. All right? Pick a partner, okay? I'm guessing you've all made eye contact with your partner so far. If you haven't, here's your chance. All right? Now, I'm going to give you a question, and in the next 1 minute, you're going to have a discussion with that partner about this question. And this is the question. The question is, how do you make your personal investment choices? Do you, number one, use your head, which is what is the right thing to do? Number two, do you take your decisions from the heart, which is what feels the best? Number three, do you take decisions from the gut, which is what is going to turn into a good investment memory? So remember, head, heart, or gut. How do you make your personal investment choices? And I invite you to have this conversation for the next 2 minutes. You've picked a partner already? Okay? Remember, how do you make your personal investment choices? From your head, from your heart, or your gut? Head, what is the right thing to do? Heart, what feels the best? Gut, what will turn into a good investment memory? So you don't have a partner? Let me find you a partner. Ma'am, could you please come forward? I'll get you a partner. Hold on. Hi, can you have that conversation? You have a partner already? Who doesn't have a partner? Sir, you've done the conversation, then you can have a side conversation also. Or you can have a group of 3 people. How do you make your personal investment choices? Head, heart, or gut? Wow, some of you have been pretty straightforward, I can see. Okay, so I'm getting a cue. You know, I'm thinking, why don't I also ask some people what, sir, badi achhi smile hai aapki, aap bataiye, how do you make your personal investment? You seem to be a very honest person and someone who's very forthcoming with your answer. Tell me.
I think that way I'll be exuding a lot of trust. So, but yeah, I think in my personal decisions, it's a mix of everything, right? It will be from my head because, you know, when you need to analyze data, you need to have a dispassionate view on what is there. It will be a bit of heart because, you know, you invest for, you know, what you stand for, you know, unless you stand for the vision of the company or vision of the investment, you may not stick around and make a lot of money in that. And it'll be a bit of gut as well because, you know, there's never enough data to give you a, you know, final view, right? Some of it you have to just, it's a bit of a hunch as well.
All right, so we have someone, so what's your name?
I'm Gaurav.
Okay, so Gaurav says for him, it's a mix of all 3. I can imagine that at the end of this conversation, you would not only have given your perspective, but would have also gotten a fresh perspective. Talking about fresh perspectives, wow, I just love how we all human beings are social animals. I gave you a question and I can hear you guys having conversations about what are your plans for the weekend. Hey, everybody, can I have your attention back? All right, everyone, eyes on stage. Time to introduce our next panel. They are here to give us some profound insights as they delve into the captivating realm of AA and AI in the mutual fund landscape. They're here to explore what we call the next wave of innovation. I think this is surely going to be quite a riveting discussion that's going to really unveil how tech and the future of tech is going to reshape our future and is going to help us all usher into unprecedented growth. All right, let's, without any further ado, invite our moderator for this discussion on stage. Please put your hands together for special correspondent Mint, Shipra Singh. Hi, Shipra. Sorry I had you wait there for a couple of minutes to set the stage up. Welcome. Shipra is going to be in conversation with Varun Sridhar, CEO, Paytm Money. Dr. Chetan Mehra, Head Quantitative Investments, PMS and Alternative Investments, Bandhan AMC Limited. Vetri Subramanyam, Chief Investment Officer, UTI Asset Management Company Limited. Everybody, please put your hands together, make some noise, come on. Thank you. And Shipra, over to you.
Hello. Yeah. Hi, thanks to speakers and everyone for joining us today. So as Xenia rightly set the stage that we are here to talk about, the next wave of innovation in the MF industry. So I want to start the session with this very question. If one by one you could share your views on what do you think according to you is the next wave of innovation in the MF industry? Yeah, we can start with you, Chetan.
I'd say, as the previous speaker was also talking, mentioning, that it will be passives will be coming in some shape or form. I'd say there will be a lot more quantitative investing coming through, and that's my space. So that's what I'm pretty sure of.
Hey, thank you for inviting us. I think on at least on the side of Paytm Money, here is how we think about it. There are two ends of the spectrum. How can we get there are 350 million UPI users today in India, but the mutual fund base is so small, right? How do you get about another 100 million people, 200 million people into MF, right? And I think that's going to be a big job. Somewhere, it's easy in India to buy something for 500 rupees, but you can't buy an MF, right? And I think it's really difficult. You have to hop through KRA, then you have to hop through different things, and you have to do a bunch of stuff to do your first 500 rupee investment. And I think someone, somewhere, an AMC, somebody like us has to flip that around and say, hey, how can you make it easy? So I think that's one big wave that somebody's going to come and do a UPI in this sector and say, I'm going to have 300 million investors. Right? And I think the day that happens, this whole sector will take a important change. So that's on one end. The second end is about account aggregator. I think it's a fantastic new thing that's happening in India. And that's on the other end of the spectrum, which is with, I would say, richer / more advanced / people who are already in the category. Right? Because there, all of a sudden, now data and technology can flip the game. Because for the first time in India, I think, we all think of households, right? Like if somebody asks me, what's your wealth? I'll calculate the whole wealth of my family and say it. But because our PAN cards are independent, we have different accounts. So there's actually no one place that anybody here in the room can say the wealth of my family today is so much. And I think account aggregator is going to flip that problem statement and make it very easy to be seen on an app 10 times a day. So I think these two ends of the spectrum, and we can talk about it as we go forward.
So, Chopra, I'm going to flip that around a little bit, and I'll borrow something which Swaroop said, which is we are a fiduciary business, right? So in a fiduciary business, I don't actually prioritize innovation for the sake of innovation. I don't think that's what you should do in a fiduciary business where you're dealing with other people's money. I think some of the innovations have happened in the external ecosystem. We need to figure out how we can incorporate that into our business model to reduce friction for customers, to increase the extent of conversation we have with the customers and the extent to which we can educate to onboard new customers. So that is where we would really like to use innovation. Finally, and again, just looking back at the landscape that both Ashish and Swaroop pointed to, I remember this conversation I had with the guys who run Baskin-Robbins many years ago, and I asked them which ice creams sell the most, and they said it's vanilla, it's chocolate, it's strawberry, right? That's it, right? So I don't think as an industry we have sold enough vanilla, strawberry and chocolate. As far as selling bubblegum ice cream and blueberry ice cream is concerned, we'll do a little bit of that, but I think our task is to get the vanilla, chocolate and strawberry out there in large measure.
Right, quite interesting. So Vetri, just adding to what you said, you pointed out three things. So where do you think AI can help AMCs in solving these three challenges and aiding these three challenges that you just pointed?
Sure. So when you talk about AI, and when you first told me about this panel, I was worried that you will ask me to talk about investing in AI, which at this point of time, I think is still a sort of blue sky area. But when it comes to using AI in business, from an asset management point of view, I think we are eventually in the business of alpha. Right, creating that additional value for investors. So clearly AI can be used over there for pattern recognition, in the allied domain for better risk management, and I think that feeds into the core of what we do, which is investment management and the management of risk. The second part in which I think AI will be used by asset management companies is, remember, we are actually a very high volume transaction processing business. Right from the trades which flow through us to customer level transactions. Obviously, there are different outsourced bodies or stakeholders who work with us, but I think a lot of that can be simplified using AI. And finally, it comes back to the earlier point I made. When it comes to conversations with the customers, which are transactional, which can be educational, I think once again over there is tremendous scope to use AI. I think as far as the alpha space is concerned, I'll just add one caveat, which is that to my mind, all good investing is a combination of science plus art. Now we can debate whether it is 80% science, 90% science, only 20% science, the rest is art, but it is a combination. And therefore I think the AI can play a very significant role on the science part. But I think you will eventually need that little bit of art to kick in, particularly in the active side of the business. And as a good pilot once told me, when you hit a crisis, it really matters if you have an experienced pilot at the controls. You don't rely on fly-by-wire at that point of time.
Right. Chetan, what is your take on this?
So all the things that she mentioned. It can also help, see, anywhere you have data, good quality data, you can use machine learning to make better models. In fact, most machine learning will improve an existing model, because when you look at an existing model, you actually, which you've taken out of a book, or even if it's a regression equation, you actually don't know whether you've underfit or overfit it. You have absolutely no idea how to assess whether you should take 10 years worth of data to calculate a beta, 5, 3, 2, 1, what's the noise level? So in terms of using machine learning for that, you will always trump an existing standard box standard quant model. The other take I have is, if you have a lot of customers, which you have in mutual fund industry, means you have a lot of data. That means you can create profiles of customers. You can see what their income is, where they like to invest, how they like to invest, what are their holding periods. You can create products, or you can help sales to sell the right product to them, or even push certain kind of products which would suit them, because you can really classify them extremely well based on their entire distribution of, so as somebody mentioned, there were 3.8 crore mutual fund investors. That's a fantastic number. You can create a nice distribution. You can really take out a lot of information out of it and create product which would suit them. So I think in sales, you can do a tremendous amount of things. And the more data you have, the better it is. But most of the time, the challenge is, how do you treat the data? So as Vetri mentioned, you need an experienced pilot. The biggest challenge with most machine learning problems is generally people just hire a couple of guys, throw the data at them, and say, well, do something with this. What you really need is domain knowledge to really figure out what the boundaries are within which you will do machine learning, how you'll treat the data, and how you'll interpret the data. So on the face of it, it seems very simple. It's actually a huge amount of work with data. We spend 75% of our time figuring out whether the data quality is good. And data quality in India is a big challenge. So we spend most of our time trying to figure out, is this even going to be good enough? Because the model will be learnt from the data. It's not coming from a book.
Right. Very rightly said. Varun, for somebody like Paytm Money, I'm sure the use cases are much more. So of AI. So what do you have to say?
I think here is the problem statement which maybe AI can solve, which is around education, right? So let's take this room, right? I'm sure everybody here understands what an NAV is, right? I'm a Tamilian. When I was mentioning it to somebody who was there, he said, "Sir, ye kaun sa naya Tamilian naam hai?" Right? Because most people outside of this room do not understand at all the language we talk in this room, right? Unfortunately, we made sure that mutual fund is in English. As a distributor, I keep telling people, hey, when can I get a Hindi, Tamil, Telugu, Kannada, Gujarati, etc., version? But there's none of that, right? Because we talk NAV. We start off with NAV, we start off with schemes, we start off with hybrid, multi-asset, debt. Just think about it for the guy outside or the people who are here, right? Who are not capital market people like us. It's impossible to understand that language. Now, here is what AI can do, right? All of a sudden, a large language model, very simply put, to add to your point, if we were to get basic domain knowledge in, you could very quickly have an Hindi-only investor app. You could actually go ahead and then communicate during onboarding, what does this mean? You could then communicate when the market goes down in the local language, right? And you can maybe do it in English or in Gujenglish or in Taminglish, or there's a nice movie getting released in Chennai, I think, today, tomorrow, and there's an office holiday. So everybody's going to be talking in that language in that state. And I think AI can literally come and solve that problem. So that's one end of the spectrum, which I feel technology, data sciences can get together and maybe convert the funnel all the way from generating curiosity to getting onboarded, to getting this first SIP started, and so on and so forth. The second part where I think it can help is complex investors who don't have time. We have a bunch of investors now, and we've done about 25 million transactions annually in mutual funds. We have a bunch of investors who have at least 30 schemes in their portfolio. It's kind of crazy. Right now, you're having 30 schemes. I don't know how they track it. Right? Like, just imagine 30 schemes, and they're doing all these SIPs. So I feel somewhere a lot of lookalike models, a lot of what's the next best, how do you churn, how do you keep your portfolios together, what do you do? I think some of that can become very automated, because at the end of the day, MF is a very thin spread business. Right? Everybody sitting here actually makes very, very thin spreads. It's a business of scale and volume. So to get that right, you need to bring your costs down, right? Be it transaction costs or be it cost of distribution. So to do that, I think AI will again come in, and technology generally, and not using the words AI for the sake of it, but data science combined with tech can literally help in cost reduction.
Right. In addition to that is that, how do you get access to quality data, which about 2 years since account aggregator system was made live. So how is that being used by, the wealth management industry and the investment industry at large to make the life of an average investor better?
So first, I haven't really seen a lot of takeoff on getting started, right?
Yeah.
I would be very bullish on account aggregator because it gives you a lot of data. Simply think customers don't understand what they're giving up. Then there are conflicts of getting advice from a ARN holder versus an RIA versus a direct versus your broker. So I think some of these conflicts will become real for people. All this, and somebody's going to launch something very simple called a portfolio doctor. Right? Like almost you get a medical checkup done, your annual checkup. Somebody's going to come and say, hit this button, product. And I suspect the first one who gets off the block, who combines.
Assume you have all the data possible, then yes, you can definitely make better informed decisions. You can really enhance the asset allocation and risk profile of a customer. But again, if you don't have good data, you really can't do any machine learning or AI. Because machine learning is essentially an optimization function to really make it simple. With bad data, it'll just optimize to bad data. Aggregate a lot of data. So I don't know if people here know that there is something called data brokers globally. They will sell you any kind of data, whether hacked, unhacked, legal, or illegal. So as we found doing some research about 10 years ago, that from the phone number or an email of a person and having access to all that data, you can create a 95% accurate profile of that person. So you need one data point to aggregate all the rest of the information as long as you have one key in that database. So yes, definitely it would enhance things dramatically, but up till now, India has no data protection laws, by the way. So you have all the data that you need. Soon it'll come out, and I don't know what the barriers will be, but have access to data and to extract information out of it. Extremely powerful, but you got to know how to do it right.
Right. But what's also the case is that I think SEBI has some reservations with the account aggregator system because it very recently came out with a consultation paper questioning whether brokers and mutual fund houses should be able to, should be excluded from functioning as financial information users, which is the, one category in the whole account aggregator ecosystem. Now, of course,
approach this a little bit differently. In our role as an asset management company, we see ourselves as manufacturers of products that investors use, either do it yourself or they're being advised by somebody. So I'm not so sure that we want to cross that Rubicon and get to the other side. The other point I'll make, and I'm sure there are quite a few wealth managers in this room who will echo it. Very often when I talk to friends in the industry, they'll say, but I don't have full visibility because the customer wants to keep it separate. He's actually talking, he or she is talking to 2 or 3 advisors or managers at the other end. So this is not as simple as us saying, here's the way to do it. Does the customer really want to do it? And what's the benefit to the customer? I think we need to think.
At least we've been very happy to see that consultation papers are out. You write and they listen, and there's a lot of dialogue. They even call you back for clarifications. We go deep inside it and understand. Here is what we feel. On this whole account aggregator thing, I think what's important is consumer data privacy protection. Because a lot of them should understand what they're signing up for. Point 1. Point 2, I think it should be allowed, at least in our opinion, to regulated entities. Right? What is regulated entity as per SEBI? Again, is a discussion, right? Because you could be registered as a ARN holder, or you could be what I would call as Paytm Money as an INZ broker code, right? Therefore, you're far more regulated. I think as you get down into the deeper details, I'm sure, looking at the consultative paper, that the direction is right. Look, we'll have to agree that at the end of the day, like Vetri correctly said, it's the user's data, right? And he or she must understand, it's like your credit report, right? How much of your credit report, I remember in 2006, 2007, I used to be in lending. When CIBIL was launched, everybody said this data is inaccurate, this won't work, etc., etc. Fast forward yourself 15, 17 years, I think the lending space, RBI has done a fantastic job of getting this together. So if we were to fast forward ourselves another decade or 15 years, I think AA has a lot of sense as long as it's run conservatively and it's run with consumer protection at the highest level. And I think that's what will happen.
Right, right. Yeah, because the 2 main concerns seems to be one, of course, mis-selling, because when you have that kind of data at hand, you know what to sell to whom. And the second is, frauds, online frauds, because, gullible investors could give their OTPs and all kind of, sensitive information during onboarding. Right. So, Chetan, I want to ask you the same question that what are your thoughts on the SEBI consultation paper about, whether all the regulator entities should be allowed to become users or not of?
I agree with the point that the customer's data is the customer's data and their protection should come first, bar anything. But again, we also do a lot of silly things which are actually some of them are actually banned because they are easy to snag. Like for example, in the European Union, sending an OTP is illegal because it's very easy to snag it from thin air. From a Wi-Fi system here, you could snag somebody's email, right? And if somebody's sending me an OTP right now, somebody with a receiver and a laptop and some good tools installed can snag that. So it kind of depends how fast we evolve. You would expect that since a lot of these things are known, we would go 2 or 3 generations ahead and get to the final solution, which is how do we get to something which is best for the customer? But we seem to be taking smaller and smaller steps, make sure we go through the evolution by falling and learning again, even though we know where the tech needs to be. But yeah, I mean, a customer has to have their data protected, but as Swaroop pointed out, if they don't trust you, they're not going to share your data. So trust is fundamental, and that comes from doing the right thing again and again and again, and holding the wrong people accountable.
Right, right. So we still have some time left. So if there are any questions from the audience?
Yeah, my question is, whenever we are talking about innovation, there are certain things which are wonderful products given by AMCs themselves, which are value STPs, flexi SIPs, there are triggers set. So what is stopping MF industry except 2 AMCs, as per my knowledge, nobody is offering it online. So may it be a flexi SIP, may it be a value STP. So because there is a paperwork involved, because we need to create new mandates for flexi SIP separately, rather than using the current mandates if we are working with MFU or BAC NSE for that matter. So is the cost only thing which is stopping AMCs to continue, like provide this innovation online, which will make it more useful? And second thing on the asset aggregator model, when we were so much enthusiastic about asset aggregator model, and now you go to AIS for the IT return, you get all the data. So that is one part. So whenever there are redemptions, you have all the data available already. And second thing, when we have mutual fund as a solution, why do we need to move to another assets itself? When we are very much interested in knowing which different assets some investor or ourselves have invested in, mutual funds give us all the ways. Like there is no such industry which will give you CAGR. There is no such industry which will give you capital gain report, which will be same given by all the brokers. It is not about the direct equity also. So that's what the question is.
You want to take it, Maitri?
I'm happy to take that detailed question back to my team and ask them to work on some of the solutions you asked for. Please connect, and happy to take that forward.
Maybe I can at least I want to answer on the other asset classes, non-mutual fund. I'll take a small example of what Swaroop had mentioned about FANG ETF, right? I'll give you a startling number today of Paytm Money's. So we have a direct mutual fund business, and we have a demat business, and we have an NPS business, right? So these are the 3 different products that we offer. And very recently we launched a bonds platform, right? Where you can buy a direct bond. And I was hearing with a lot of intent, and it was very nice to hear the whole debt mutual fund conversation. But here is the stat. 26% of our customers today have at least 1 ETF. The minute they have 1 ETF, they have about 6 ETFs within the first 3 months, right? That's not a small number. We launched our bonds platform about 45 days back. So essentially you can log into Paytm Money and buy a central government bond for 39 years at 7.4%, right? This is off the market. This is off the exchange, right? So there is no us taking, it's not the OBP regulation. because you seem to be somebody who understands all this, right? So as an advisor, you can't just say it's mutual fund because the client is not thinking that anymore. The client has already changed his perspective, right? Our clients have bought about 100 crores of bonds in the last 45 days, directly. Zero marketing, zero nothing, mostly central government bonds, right? And they're very happy. We were talking about returns earlier. They're happy with 7.5%. They're happy with 7%. All they want is stability, a lot of them, because it's not the 100% of the portfolio. So here is the thing. I think somehow the account aggregator model, or in whichever other way you want to get it, but I think as an advisor, and that's what we are trying to do at least, is to look at the 360 degree. Because I think at least we owe our clients the ability to present them, he or her, at least the number easily and in an understandable way. Then whether they decide to consult us for that or not is another second topic. But I think the level 1 problem to solve is to put it together.
Somebody wants to ask a question here.
Yeah. This is not a question, but after listening to you guys, I think there is an industry house which has just demerged their financial arm and will be coming out with a financial conglomerate which will have a disruptive impact in this market because they disrupted telecom, they disrupted retail. So all those changes what we are anticipating, whether it is artificial intelligence based or machine learning based or cost wise, I think we'll get to see that in a few months. That will be a paradigm shift, I think, for our industry. I'm sure that this is not a question which I want to ask because we'll all be guessing. Thank you. Good discussion.
Yeah, hi. Hi, this is Atul Mehra here. I have a question for Varun on the innovation side. Typically, as we all know, business of investing is more about trust, and that's the bedrock of investing, and even advisory for that matter. So, how do you, being a digital company, how do you convert and build on trust digitally? Because as we all know, like the reach of digital is infinitely more than in-person reach. So how do you create this trust? And is the trust. So how do you innovate on trust in a digital environment? Thanks.
It's a tough, it's the toughest question. Everybody keeps asking me that question, from Vijay to my investors to you to my consumers, saying, hey, how do we do it and how do we trust? Now, I'll give you some stats because I think that's easier. We've crossed about 15,000 crores of AUM. We do about 150 million transactions a year. I think it starts with the baby step. And most of our customers, I know, don't have more than maybe 10 to 15% of their assets or their values with Paytm Money, for example. But slowly, they take the baby step. How does that happen? I think the digital product allows you to remove what I would call human emotion, bias of selling, etc., from a perspective of a distributor like us, right? That's what you would call us, or a broker in another capacity. How do you do that? I think it's a question of transparency, right? How transparent, how easy, how simple do you make it? Because, and I'll go back to the bonds platform, right? Literally, you can go there and you see 3 different, you can buy corporate bond, government bond, you can filter, you can do what you like, right? It's as simple as that. There is nowhere advice, right? We don't do advice. Because I believe that, okay, who am I to advise millions of users across India? It's really tough. Data is not accurate. I can't know a consumer digitally like a physical advisor can. We can never win that. So I think is, as a digital technology platform, you've got to decide what's your boundary, what are you good at, what can you do. And once you do that, I think you need to deliver it reliably, right? Now, what happens sometimes is customers go through tough periods, right? And I think that's where trust gets built or broken. Right now, those tough periods, I've had great days where we've literally managed to win trust by being honest, by being transparent, by being simple. On the other days, I think some of my customers have said, hey, look, we subscribed for NAV on this date, it didn't come through, it came 2 days later because somewhere some technology failed, payment didn't go through. I'm calling the AMC CEOs, I'm fighting with RTAs saying, yaar, mere 20,000 SIPs due hain, wo late ho raha hai, kya kar sakte hain? I think those moments, they break trust, right? Now, when the trust gets broken, I think it becomes very difficult to win it back. And what we do then makes the difference. right? Now regulator says, okay, you can't do this, you can't do that, I can't give backdated NAV. So that's gone out of the window, right? So all of a sudden my consumer has lost by going digital and going DIY. But I think it's a journey where over a long period of time, if you're delivering 98, 99% and step by step you do it correctly, I think you improve. The second leg is education. I think digital education is critical. Without that, nothing is going to happen. A lot of our customers are first time to market. A lot of our customers start off with 500 rupee SIPs. I've been fighting with the industry to say, hey, when can you allow us to pay your burger or your Golgappa with a mutual fund? Right? Because I think the day we can do that, we'll get trust. Right? And the name that the Paytm brand has earned on payments, will we be able to earn it on investments? Yes, but I think it's a journey. Right? We are in year 4 of our journey. So I think there's a long way to go, but we're confident as long as we continue doing the right thing, we do the fiduciary things, and we're focused on transparency. I'm sure it will come through.
Thank you very much. Just one follow-up to that. So one of the fintechs, Policy Bazaar, we've seen that they are in a way doing a hybrid to some extent, where while you have the typical platform being online, they also are now trying to have an offline presence. Do you believe in your area of operations and the broader financial services, in order to fill this trust deficit, there is a need to do hybrid?
I won't comment about competition or anybody else. I think I'm not equipped or the expert there. At least I can comment about what we think. We're going to try and solve the problem digitally. And that's the long run, because today I have one customer in every pin code of India for mutual funds. Right? And I think equally so, the physical mutual fund ARN distributor is fantastic. Right? Because what he or she knows, the Mr. Sharmaji around the corner, or I was sitting with somebody and he was talking to me about his investment strategy. They're just fantastic people. I don't think we can compete with them. So, like I said, I think we'll be focused on technology.
So, if we can take just one last question, because the time is up. So.
Okay, so this question is for Vetri, and my question is the active fund manager a dying species? With the coming of AI, we already have quant models, and we have a fund manager for the quant fund because SEBI mandates you to have a fund manager. That fund manager is doing nothing. Swaroop just now said that out of 17 countries, 16 countries, they are selling only passive. India is the only country where they are selling active. Varun said that the person buying an ETF now buys 6 ETFs in the next, 3 or 6 months. How long will we be able to, fight this AI, or will AI become our fund manager?
So, I'll go back to what I said earlier, which is, to me, good fund management is science plus art. And you can use AI in that science component, but eventually there is also that art component, and I don't think AI can really fill in over there. So I think you'll always have a combination. We can use AI in that science component. Maybe I won't need as many analysts as I do today, because some of the processing that they do can be done by AI. But as far as the active versus passive is concerned, my belief is they will coexist. They will coexist because both have room, and the incremental value that you get out of active in terms of the alpha that it can create for you is something that many people would say, I want that additional, right? So to my mind, these actually coexist, Deepak, but I think to Swaroop's point, we need to keep in mind that as every market evolves, as information arbitrage vanishes, as the market gets more and more well developed, well regulated, the ability to extract alpha becomes harder and harder to find ex ante, right? Post facto, you will always find that somebody had alpha. But as an investor, my challenge comes ex ante. How do I know who is it will have alpha in the future? And that is why, to my mind, you will find that significant amount of market share over a period of time will go to passive. I think the challenge for me, and I've been an active fund manager all my life, is to try and make sure that we are at that cutting edge where we are able to combine man and machine in a way, going back to my flying example, that when that crisis hits, having the man plus the machine is what will actually give you the advantage.
All right. Thank you very much to all the speakers and everyone listening. Thanks.
Thank you so much, Shipra. What an absolutely phenomenal panel. I'm going to request all our panelists to please step forward. Let's quickly capture a group photograph. Can we have another round of applause for our panelists, because they gave us some profound insights on what we can expect as the next wave of innovation and tech in the mutual fund industry. So thank you very much for that. We are just a couple of seconds away from introducing our final power panel on stage. Joining us are financial luminaries who will unravel the complexities of expense ratios and performance fees in our industry. They're here to discuss the delicate balance between cost and performance and how transparency is shaping the story of both fund managers and of investors. We are almost there, ladies and gentlemen, with setting up the stage. I want to once again remind you and invite you in the final moments of the conclave to join us on the online conversation. And please make sure you use hashtag MintMFC2023. Okay, I'm going to quickly check with my team. We're almost there. Just making sure our panelists have everything they require on stage to give us as many insights as we possibly can. Okay, I can see that we are nearly good to go. So I'm going to go ahead and invite our moderator for this discussion, who's going to curate this conversation live on the stage. Please join me in welcoming Senior Assistant Editor Mint Jash Kriplani. Jash, welcome to the stage. He's been waiting all evening to have this conversation. And I can see that broad smile on your face. You're so excited. Yes, waqt aa gaya hai. All right, and now, ladies and gentlemen, let's invite our power panelists. Radhika Gupta, Managing Director and CEO, Edelweiss AMC. Sandeep Tandon, CEO and Director, Quant Mutual Fund. Avinash Satwalekar, President, Franklin Templeton, India. And Suresh Soni, CEO, Baroda BNP Paribas Asset Management, India Private Limited. Come on, let's give them some energy, show some love to our panelists. Please take your seat. And Josh, over to you.
Good evening, everyone, and warm welcome to my panelists. So I'll be moderating this panel on expense ratios and performance fees in the mutual fund industry. Just to set the context, SEBI came out with this consultation paper on performance fees and expense ratios, and there is going to be another iteration of this. But there were a lot of interesting findings that SEBI made and a lot of interesting observations in this consultation paper. So we'll get the things rolling. And Radhika, if I can start with you. SEBI found instances of, brokerage and other additional costs being on very higher side in certain schemes. In your sense, why there has been these cases of overcharging of brokerage cost and other additional costs? If you can start with that.
So I fully expected to be the opening batsman on an extremely controversial last topic moderated by you. So I'm glad that you haven't disappointed. After Deepak Khemani, who's my friend in the audience, started by asking Vetri if Bichara active fund managers are dead, I fully knew what I was prepared for, so I'm prepared. Before I comment on this, I should say, we are mutual fund CEOs, so we should start with a disclaimer that the consultation process is mid-stage. There was a particular paper that came out that had a lot of the findings that we are, I think, going to be discussing today. There was promised to be another consultation paper because we as AMFI represented a new set of data as industry. That paper is not out, but we are told, at least from the last press conference, that it could be different. So this is work in progress. I just want to state that. Now, as far as brokerage and other expenses are concerned, what are other expenses? They are brokerage, GST, and STT. 2 out of these 3 expenses are statutory expenses, let me say that. I do not think there has been overcharging of fees. In the paper, it was pointed out that in some categories, and you said that these other expenses combined exceeded the total expense ratio of the scheme. I would venture to think that's true in only 1 or 2 categories of funds like arbitrage funds. In an arbitrage fund, and we run one of the larger arb funds in the country, when you do any churn, you pay brokerage, and because you have cash and futures position, you do churn every month. But when you do every churn, it is for the investor to make money. Finally, what a consumer gets is the NAV return, and all this shows up in the NAV return. So if a consumer is getting an NAV return that is meaningful, then you're okay. I always think a little bit of extra hullabaloo is made about expenses, because if you look at liquid funds, the industry and regulatory cap is 1%. I don't think any of us runs our liquid fund at 1% because the TER of the liquid fund and the competitiveness of the industry doesn't justify it. So I don't think overcharging can happen. You know, I was hearing someone in the previous panel was making a comment about new players and pricing disruption. We happen to run the cheapest debt mutual fund / ETF in the world already. So I don't think our industry sometimes gets enough credit for low cost pricing. But coming back to your question, I think this issue is largely the domain of select funds, including arbitrage funds, which the regulator has promised to look at, as per the statements in the press conference. In a normal equity fund, let me tell you what these expenses would be. If the fund manager is doing 40 to 50% churn, and the average brokerage rate is 8 to 10 basis points, there would be probably 5-6 paisa of brokerage, 10 paisa of STT, and a little bit more of GST on top of that. This number, I don't think, unless you're running a very high churn strategy, exceeds 20 to 30 basis points.
Avi, would you like to add to that?
Yeah, I think quite honestly, at the end of the day, what you're looking at are charges that you want to get a complete understanding of what your expenses are. To Radhika's point, 2 of the 3 that were mentioned are already set, and they're not within control. Brokerage is one thing that is driven by essentially your investment style. So if you have a high turnover strategy, your brokerage costs are going to be higher. Now, I think any investor going into a fund is going to know or understand that, or should understand that, right? That a high turnover fund is going to result in a higher level of brokerage fee. So I think having that included in there, while it may, in my mind, it would then have to make an adjustment to your investment style and approach. So that is something that we have to keep in mind when we think about those expenses.
Suresh, would you like to add anything?
Sure. So I don't think any of the funds have exceeded the regulatory ceilings per se, because that's something that no auditor or no regulator will accept. There are a couple of expense ratios which are allowed over and above the TR prescribed for the funds. One of them tends to be the GST on investment management fees. And that is outside the TR limit. Another expense ratio that is allowed outside the TR limit is B30 incentive. So a part of that extra, which SEBI has pointed out in the discussion paper, which is about 40 basis point difference, a part of that would be accounted for by these 2 items, which are statutorily allowed over and above the prescribed expense ratio. So just to kind of complete the picture, it's not that industry has gone and at random would have charged different expense ratio under the garb of the fund, but there are, apart from the TER limit, there are clear allowances that are made for these 2 items. One of which is GST on the investment management fee, and second is B30 incentive. For both, the regulations are prescribed, and that's kind of determined there.
Sandeep, would you like to add anything to?
I will definitely like to say a few things. So I think I'll answer this point later on. Let me just give you perspective. Let's understand SEBI intent first. The intent is very good to bring down the cost structure. And obviously certain provision which was showcased in that proposed tier circular, obviously a lot of people have misused. So SEBI is trying to address through some regulations. So that's the background which we have to understand. Now let's come to the expense part. Okay. Now if as a house, if as a mutual fund we have to absorb the brokerage as well as STT, then I tell you it will lead to a massive arbitrage opportunity. Mutual fund balance sheet will be wiped out, AMC balance sheet will be wiped out. I'll give you a small example. Okay, because we have done this arbitrage business for donkey's years, we understand that space quite well. Let's say example, if any investor, whatever reason, expect the market should rally 5% from today onwards because we are in bull run, and he invests 100 crore rupees on any of, let's say, put in our scheme, okay, and there is no exit load in our schemes, okay. So 100 crore rupees come, and let's say in 5 days time, he gets 2% returns, okay. So as a mutual fund, he has to just pay small STT, so he will take away 1.98% return from us in 5 days. Now if he has to go directly to the market, he has to pay brokerage, he has to pay STT on that. In this case, he is not going to play. So all the HNI and family office will come to us and look at our cost. In this process, in that entire process, we will incur, at least we have done a math on this 100 crores, we will incur a loss of 43 lakh rupees. Okay? So if we understand this math, this is not viable. We have to shut down our shop if this comes into picture. Arbitrage will kill you. Okay? So it's not practically possible that if you come to mutual fund will absorb everything. If you go directly in the market, you have to pay a price. I don't think a lot of people have understood this point when the things were getting drafted. As an arbitrager, we have done this business. We understand it's a serious flaw. I don't think it will ever get passed. And I think we have highlighted to the regulator. I'm sure regulator is very mature. They will understand. They will also not like to see a situation like this where arbitrager take advantage and mutual fund business will be wiped out. So it's a very important point.
Sandeep, as a follow-up, what do you think, another point that SEBI had made in the consultation paper was including the tax-related costs, STT, GST. Is that a feasible thing within the including that? Because they want TR to be an all-encompassing, transparent ratio for the investors.
See, again, this point is important because, see, any services you rendered, taxes are over and above, okay? To say that taxes are part of it is not fair for the industry also, because tomorrow STT moves up, tomorrow GST moves up, or it can come down also, okay? So that does not make any business sense. And I'm sure representation has gone to the regulatory bodies. I am sure they will look into it. As I said, our regulator is quite mature and we have in dialogue, MP is in talking terms with them. So I think should be sorted out because it's not viable for us to, if this get implemented, it's very difficult for us to manage.
Anybody would like to add, or I can move on to the next?
So just one point I would make on the total expense ratio for the industry. See, at the outset, we should understand this, that right now when you look at bank deposits are about 7%. Do you know what is the NIM that banks make on an average? 4%. We are an industry which produces about 14 to 16% return on our equity funds. What's the expense ratio average that the paper has put out? About 2%. So this is indeed one of the lowest cost intermediation product. The other part, if I really compare our expense ratios with what is prevalent internationally, and I just did a quick check on some of our SICAV funds, UCITS funds, and there the retail share class expense ratio I saw in one of about $300, $500 million product was about 2.2%. So at the outset, the expense ratios are not wide off what the international markets are. And compared to other financial products available, they are quite competitive.
I just want to add a few points. See, the intent part when you talk about how to bring down the cost structure, okay? So if you look at the current circular, does not address the operating cost issues, okay? They are vendors whom we pay on our AUM link services. Ideally should be transaction-based services, okay? Because they are offering a platform for transaction. But it is unfortunate there has been a practice that they take away fees on AUM basis. If we analyze, let's say, our thing, our operating cost is nearly 20%. Okay, so it's not viable. So if ideally should be a transaction based. So whole idea is that how to bring down the operating or the transaction cost down, not at the cost of innovation. Because if any brokerage guys is servicing us, he subscribe lot of databases, he's adding value, he's adding and generating my alpha. So we cannot penalize brokers for adding value, and we reward vendors who are just doing processing job and take away certain AUM from us. So I think that is the rationale we have to understand. I'm sure regulator is looking into it, because these unwarranted costs which is there. Let's take one more example. When regulator talks about that as size of the AMC grows, the TR keeps on coming down, which is a right approach. Similarly, the transaction cost of these vendor also should brought down, not as a one mutual fund, as an entire industry. If industry has crossed certain size, these costs should brought down significantly. Today, let's say, I think one of the panel member talked about with the advent of Geo coming into picture. Okay, that is a very important thing for us. If the costs remain like this and somebody offer that 10 bips or 8 bips, business is not viable. So we have to bring down the operating cost significantly rather than saying I'm bringing down the innovation cost. Then we are affecting our returns. We may not be doing justice with the investor community. The return should not be compromised because somebody offers our product. We subscribe, like we are not in the position to subscribe so much databases which the global firms give. So if they're taking a pie out of it, we are happy, should be there adding value. But if transaction guys takes our percentage AUM, which is not fair.
I would just make a point which I'm so glad Sandeep made this point. I've been harping on this for years. Is that if you look at some of the funds we run, especially passive funds and certain categories of funds, there's a component called management fee which comes to us, and there's a component called OPEX. In some funds today, OPEX has not reduced, and the total amount I pay to vendors is higher than I keep as management fee margin. To me, that seems a little bit problematic. So I think there is an equal need for economies of scale to come through in the costs that we pay to RTAs, exchanges, vendors, depositories, etc., etc. And remember, AMC is an industry where there are 45 players. So there is a natural sense of competition and pricing that happens. Liquid funds, passive funds are one example. These are industries, without taking names, with often many fewer players where the incentive to do that is less. So operating costs have to come down. I should also say, and I think I speak on all four of our behalves, running and making an AMC profitable today is hard work. It is really hard work. And as an investor, you want your asset management company to be profitable so that we can invest in future growth. Whether it's hiring databases, whether it's hiring people, this stuff is expensive. You want your asset management company to be profitable. You don't want custodian of money to happen with a company that is not financially viable.
Anything you would like to add, or?
No, I think a lot of it has been said. The only one thing I was going to say is that from a GST, as a consumer, you pay GST for a service that you receive, right? It is not the service provider that is paying the GST. So in this case, if we were to include it, it is turning that on its head to a certain extent, which, to kind of Sandeep's point, is maybe that's not necessarily fair for the AMCs.
Sure. And also, SEBI had proposed a complete kind of overhaul of the entire way TER is structured right now. It is scheme-based TER, and SEBI wants to make it AMC level TER. The way they want to do is, they want to come up with a weighted average TER for an AMC. Say, if it is equity assets, first 2,500 crore will be a certain 2.55 is the new TER they are proposing. Next 2,500 would be 2.45. Then they go down and gradually, above 50,000 crore, it's just 1.3%. So any thoughts on this? Maybe Suresh, I can start with you. How this can benefit smaller players? Can this really give them a competitive advantage?
So I think in terms of intent to do asset level TER, that's what you're referring to compared to scheme level TER. I think the intent is essentially to discourage switching in order to earn higher commission. So that seems to be the broader point. And I think in addition to what they have suggested, there could also be other ways to check that. So that could be that when you switch from fund A to fund B, the lower expense ratio or the lower brokerage will be paid and stuff. So there are less intrusive method also to achieve the same objective. So while one understands a little bit about the saying that there could be economies of scale at asset class level to a certain degree. Part of it is true. Part of it is also incrementally, if you're doing a, let's say, thematic fund, a sector-specific fund, or a different market cap, you need to add into the resources. So there is a certain part which is right there, but there can be other ways to achieve the same objective of preventing churning in order to earn higher commission. In any case, over the years, there have been a lot of steps that have been taken to prevent churning. So earlier you used to have upfront incentive, that's gone. It's full trail model. And within that, the differentials are very marginal.
Radhika, would you like to add to this?
So here I am going to go out and sort of unequivocally say that I like this suggestion. I really like this suggestion. And to me, the small AMC, big AMC part of this comes later. I think if the principle of fees is that the benefits of operating leverage should be passed to the consumer, the reality is as someone running the business, my investments or costs are not at a scheme level. If I have a team, for instance, at Edelweiss Mutual Fund, we have 3 teams. We have an equity team, we have a hybrid team, and we have a fixed income team. My costs are actually at an asset class level. So if my fixed income AUM or if my equity AUM hits a certain size, then yes, I am getting economies of scale. I don't have economies of scale in balanced advantage fund versus aggressive hybrid fund. Broadly, the same team is running them. Of course, there are exceptions, you know, thematic funds, etc., etc. But for the most part, I think the principle is grounded in fairness. Now, will it lead to a slight competitive advantage for small AMCs versus mid versus large? People say that, and it may lead to an advantage on the pricing front. But I don't think that's the complete picture. So I've seen us at 6,000 crores and 1.1 lakh crores. The reality is that when a consumer buys a fund or when a distributor goes to sell a fund, it's not just because a smaller AMC XYZ is paying you a little more brokerage than a large AMC. It doesn't mean the small AMC sells, otherwise nobody would have been a small AMC. Even today, small schemes, because there is a merit to brand that has been built over time. There's all of that. So there is, for anyone who's small, there is a real struggle to grow, and many of us have been through this. So does this create an unlevel playing field for large AMCs versus small AMCs? I don't think so. Also, you have to remember people who are, and the large and small is a function of when you started the business. It's young and old. If you're building today, you don't have the advantage of back book that a lot of people had in the early era. So a little bit of advantage because you don't have that playing field of brand, I don't think is a big deal. So I am principally very happy with this.
Right, Sandeep, and then we will come to Avi.
So I agree what Radhika has talked about, you know, it's a very good step because the operating cost link at the overall company level, the organization level rather than a scheme level. So it's very healthy. And obviously it will also support the young AMC, the smaller AMC, they can innovate things better. So it's a good support which we can offer to the emerging AMC. That's point number 1. And the second thing which Suresh talked about, obviously if this can be implemented, then switching will be stopped. The people should, for just for the commission's sake. We have seen this phenomena quite common in the industry in the regular plan. When the NFO comes, people tend to switch. And I think this is one of the important observations SEBI has talked about. And I think it makes logical sense to implement this thing. We'll be very happy if it gets implemented.
So I think any regulation or any, I think at the core, there's typically 3 things that I think, at least I'm looking at, right? One is, does this help us in terms of increasing financial inclusion and increasing the education of our investor base? 2, is it helping reduce churn in terms of either, or basically encouraging longer term investing? And then lastly, is it helping us develop the overall size of our market? Now, when we look at this change, this is definitely a positive in the sense that it does pass on the economies of scale to the investors. Now, broadly speaking, does that have to happen in a vacuum? It doesn't. Because to the advantage, I know we talked about the fact that the smaller AMCs will have a slight advantage. Now, an advantage at the smaller thing assumes that pricing is the predominant reason why an investor makes a decision. And that is not necessarily the case at all. Because if that were the case, then the large AMCs are at an inherent disadvantage always. So that is clearly not the case. So in my mind, while this is a it is a good development because it does to a certain extent give a level playing field and does allow the smaller AMCs to create at least some interest around it by allowing them with one lever that works. But that is not sufficient. That is not going to be the only driver. So I think there are a number of factors that need to be looked in. This is one element of it. Now, when we look at economies of scale and the advantages being passed on to the investors, the drive, and that's where I think education becomes that much more important. Because unless an investor base is educated that they can make the right financial decisions, they're always going to need some level of guidance or should have some level of guidance. Because if they don't, then the result is going to be actually worse off for an investor that is making ill-informed decisions. So this, I think, is actually a good step in, at least it's a good step in the right direction.
Right. Avi, as a follow-up, Sandeep also mentioned that, SEBI had observed that there have been a lot of churning of investor portfolios, right? So any thoughts on this? Can this alone be enough to, stop mis-selling happening, or can there be more best practices that can be evolved to, address this issue?
So I think churning, not all churning is bad, right? And that doesn't necessarily mean that this will necessarily curtail churning either. But it goes back to one of the elements that I talked about, which is educating the investor base. Educating and making sure that people understand the value of staying long term. I think one of the stats put out there was that 70% hold their investments for less than 2 years. Right? Now that is a significantly short period. But to put that in perspective, globally, holding periods have been shrinking dramatically. So if I look back a few decades ago, even in the US, holding periods were measured in years. Today, they're measured in months. So if you've held something for 6 months, you might be considered a long-term investor, right? Which is an unfortunate reality. Now, we all know sitting in the room that the only way to truly create wealth is to leverage the whole concept of compounding, which in 2 years is not going to happen. Right? So anything that drives down the churn or reduces or encourages longer term investing gets absolute support across the board.
Can I go to Suresh and then I'll come back to Radhika and Sandeep?
Sure. So I think reducing churn is a very noble objective. None of us would disagree with it per se, because if you're shifting too often, then you just can't take the benefit of compounding. So that's pretty much standard thing that all of us would have. One of the driver, and if for distributors, could be alleged that some part of it could be because of the earning higher commission. I think the incentive is marginal. One has seen churn even in passive funds, which was, same study finds that passive funds also there has been a churn of about 15%. So there's some amount of natural churn which continues to happen because investors probably maybe sometimes want to switch to a new theme or whatever. But indeed, this number is a little higher in case of active fund, which is about 27%. So I think at the margin it would help a bit, but may not eliminate it completely.
Radhika?
So I have a slightly different point here, which is that, there's churn for all kind of reasons. There's churn from underperforming funds to well-performing funds. There's churn from fixed income to equity. These are all good forms of churn. And there's some bad churn, that happens. I don't think it is fair to attribute all churn to mis-selling and distribution. And let me give you data on this. So we published a report on intermediation for our own assets at the end of March. It's on our website. Anyone can see it. It's called the COGS. And to Avi's point on compounding, we looked at percentage of assets that have been with us for the long term, which is more than 2 years. Sorry, it was 2 years. If I had done 5, the problem ho jata. But we looked at just 2 years. Now, in the regular plan, that number was in excess of 30%. In the direct plan, where there is no distribution, so there can't be any mis-selling, it was 14%. So some of all churn does not happen due to mis-selling. In fact, at least our data seems to suggest that distributed assets have done a better job in terms of longevity than direct assets. Perhaps the real need is a lot more investor education and less chasing of one-year returns.
Sandeep, like to add?
Yeah, I agree what Avinash talked about is about that education is very important. And I also agree what Radhika said, that churn should not be just looked at as bad churn, okay? It's a need-based thing, you know? Switching from underperformance to outperformance, switching from asset classes, you know, from a taxation perspective. And it's a completely human-driven approach, you know. And there's a human cycle there, you know, wherever somebody can make extra money, people tend to make it, okay? And then also we have to understand that our real distributors, they are not real wealth manager, but over a period of time, they are also building their experience, you know, in advising in asset allocation, which leads to a churn. So I think they're also learning and evolving. So I think churn or switching, I will not the word use churn because churn we use more from the portfolio perspective, but more from a switching point of view. Every switching is not bad. Okay, so we have to be very careful in just making a generalizing that the churns are bad, but maybe yes, regular churn which happen for a very short-term opportunity, I think is depending on the management of AMC or the marketing team, how we groom the people and how well we convey. I think it's over a period of time people will learn that.
Right, and SEBI has also, proposed sort of, trying to experiment with performance fees in the mutual fund industry. One approach they have come up with is, having a TER at maximum limit of passive schemes, and that then there can be an indicative return, and then even higher TERs, asset management fees can be charged by, mutual funds. It's, more on an experimentation level, but any thoughts on this, Suresh, if we can start with you, and then we can go to others.
I think the concept is good. Very clearly, when you are linking the fees to the outcome, I think it makes sense. So from a perspective of idea, I think it's a very good idea. Just that at this point of time, there are a number of operating challenges that you would see because in the manner of charging, essentially you either charge it at annual basis, but at the same time, you claw back when the investor actually exits. So you have to recompute the whole thing as to whether the investor in the end made money or not. And based on that, you charge a performance fee, which is a fairly complicated accounting thing to do and track it at investors' level. I think it's a lot easier if it is done in a closed-ended fund because there all the investors exit on a certain day. And therefore, you can determine what's the performance of that fund has been from start to end, where everybody comes on a uniform date and exits on a uniform date, rather than having to track every investor by investor. So therefore, I think concept is very good. We'll have to find a practical way of implementing it, but I like the idea.
Avi, anything on this?
Yeah, I completely agree. I think conceptually and in theory, it is a very good idea, right? I mean, the concept of being paid for an outcome, right? Operational challenges aside, right? I think that fundamentally it does require a certain change in the way we structure even our regular, right now we've got 2 share classes effectively. Theoretically, you could create another share class, right? That would be a performance fee based share class. Now, the operating challenges are there, right? But it is something that can be worked on, and which is why I think it is right now in the sandbox to do precisely that. So eventually I think there will be a good solution that comes out of it. And I think there will be certain people, but I kind of go back to the whole concept of the purpose of introducing something like this is not so that you can drive your fees down, right? I mean, if you approach your entire investment decision on only the fee structure, you are never going to actually create significant amount of wealth, right? Because not always the cheapest fund is the best performing fund, right? It never happens. Neither is the most expensive fund the best performing or the worst performing, right? You go through phases. So I think performance fee as a concept is very good. How we implement it is what's going to be the challenge, because there is not an easy process to doing it, right?
Radhika, would you like to add?
So I come from the alternatives world, and prima facie, I believe optionality is good. What I like is that this is an option for AMCs, and I think the proposition to the investor that, look, if I don't beat the benchmark, you're just paying passive costs, is a very nice sales proposition. And perhaps as AMCs, we can take the call to experiment this in certain kinds of schemes. For instance, I run a recently listed high alpha IPO scheme, which might just lend itself very nicely to this. I think there are two parts to this. Both of the gentlemen talked about the operating challenges, not just in executing, but in also explaining performance fees to clients. You know, I mean, our level of financial literacy is reasonably basic today, and this is a retail vehicle. So explaining this to clients is complicated. The second thing is it should never be seen as a way to save money. In fact, I would think of it as the opposite. You know, if the contours are right, and by performing, the AMC is actually able to earn, incentivize fund managers, yet not incentivize them to take too much risk, because performance fees have that. So that structure needs to be worked out well.
Sandeep.
So currently what SEBI consultation people talk about through sandbox approach, okay, but we will be very happy if we get implemented in real life, okay. Yes, like globally look at the T20 model, T220 model exists for hedge fund or PMS or AI, but I think SEBI can be, yes, there are operating challenges. When you talk about fees should be yearly, quarterly, or the track record of fund manager or fund house or operating or the processes you are talking about. My simple thing is that if you want to really implement, we can implement it on monthly basis. Monthly outperformance, next 1 month you get extra fees, you underperform, it comes down, okay? So there is a clear incentive for the money manager and the fund house to ensure it's put a lot of pressure on money manager, and I think it will be in a larger interest will be very good. And it should be well disclosed in SID. What is the percentage? If you're looking at 2% outperformance, 3% outperformance, then SEBI should look into it. We will welcome that stand on monthly basis, easy to implement, otherwise it will remain a theoretical exercise.
Great. So Quant can take the lead in that. We'll be waiting and watching.
We are for it.
Right. Yeah, before I conclude, you know, one data point that SEBI pointed out in the consultation paper was that only 25% of the MF folios belong to women investors. So Radhika, can I start with you? What more can be done to get more women to invest in mutual funds?
This is not an answer for 20 seconds. Although I think SEBI has proposed a couple of things in the consultation paper, including additional incentives on women investors. Must tell you though that in the data that AMFI released a few months ago, one of the fastest growing categories of investors was women investors and young women investors, so 20 to 35. I think the ecosystem needs to do a lot more for the cause of women investors. You know, regardless of what you think of the companies, the listing of companies like Nykaa tells you that India's women are a serious and growing consumer base, and all of us would be silly not to take advantage of it. But this is a long problem that needs a much longer debate. It includes role modeling, inclusion. I mean, there's so much stuff to talk about. But the fact that SEBI has at least talked about incentives for women investors, 20% women IAPs, at least we're recognizing the problem.
Right. Avi, would you like to add?
Yeah, I think this is, I mean, just take a look at our room here, right? I mean, I can count the number of women in probably my two
Or our
hands.
stage.
Yeah, or on stage. So I think actually having more women investors is a very important thing for multiple levels. I think there's enough, I'm sure you've all seen enough microfinance studies that show having a financially literate woman has a community impact versus an individual or a family impact when a male is financially literate. So I think there are a lot of social benefits to it as well. So, I mean, one of the things we've found, at least in our own research, is that there's no reason why it can't be done. It just hasn't, right? I mean, even when I look at our teams, and we just did a kind of an anecdotal study and asked, say, okay, You're all working in the mutual fund industry. How many of you are actually managing your own investments? And we got maybe 1 or 2 people that put their hands up. And this is in our business. They are all making substantial amount of money. But who does it? You take your pick. Father, uncle, brother, anybody but them. Right? So it goes back to the point I was talking about, which is literacy and education. And I'm not talking about just overall literacy. I mean, I think it's clear from our graduation stats that women have been increasing and there's more graduating class women than there are men. But financial education and then being able to take charge of that, that is a critical factor. So anything that supports that, I think in my mind is an absolute no-brainer, quite honestly.
I'm just going to add one point of, actually 2 points of data. You know, we are a 30% women company. And we are actually, I think industry is about 30% women investors. Without doing any campaigns for women investors or anything special, somehow we realized we're 37% women investors. And when we go out and do distribution meets, because I travel a lot, multiple girls tell me, more women just show up, more women IFAs just show up. So having more women in the ecosystem, actually, without us doing much more effort, draws more women to the ecosystem. I'm also going to share you a smart stat on how good women are this. So we looked at our product-wise contribution by women, thematic funds, Edelweiss, Greater China Fund, US Tech Fund, 15% women investors. Like good dal chawal funds, like balanced advantage funds, 40% women investors.
Suresh?
No, so I think there's been enough data about it, so I completely agree with it. I think there are 2 challenges that we face as a nation, I think. Apart from women's investment being low, we also have a much lower women participation in workforce. And that is something that holds us back as a nation. So not only the investment, which is absolutely important here, and I'm glad SEBI has identified this issue, but we have to actually solve as a country this at multiple levels. The labor force participation being a big one, where we lack almost every other country.
Sandeep?
Yeah, I agree with that. SEBI at least is acknowledging that this something should be done. But I have a very different perspective because it's a very difficult task. Okay, talking is very easy and implementing is very difficult. The best option is to just create awareness, educate people, because I believe the next generation, gender biases are getting diluted. At least in my generation, I have seen still biases. My dad's generation, there were very clear biases. When I look at my kids and next generation, the biases are not there, okay? So if you educate, so we go out and educate a lot of people and encourage young generation to come. And I think the biases are not there. And if we can do that, we are able to address in a different manner and we'll achieve our goal.
Okay, I don't think we have much time left, but we can maybe squeeze in just one question if anybody has. Okay, please.
Would you say innovation in asset allocation is lopsided as it aggregates existing sophistication in contrast to increasing literacy as a whole among the base?
Can you repeat? I mean, I don't think they got it.
What I meant was, would you say innovation in asset allocation is lopsided as it aggregates existing sophistication when it comes to mutual funds and other asset classes, and not on increasing the literacy among the customer base or the base?
You are saying that through innovation is...
Do you think it is lopsided when it comes to asset allocation? And it is only more towards increasing the amount of sophistication that is there when it comes to AI and other things, and not on increasing the the base through which actually funds start.
We have understood right. See, don't mix up innovation with asset allocation.
Right.
Asset allocation is very individualistic need based on your risk profiling, your age, your perspective.
But AI is taking it over. That's
no. See, very clear. don't mix up. Asset allocation is an individualistic approach. Don't bring AI and innovation. You can't do any innovation. It's my need. Based on my need, I will decide. Yes, innovation can be done on all the product. I think we have series of panel discussion on that. So don't get confused with that. That's only my suggestion.
Can I just make a point on AI? Because every single location I've been traveling, everyone's been telling me that all of us are not going to have jobs in a few years because of AI. So I'm going to ask you guys a question. AI is innovative, right? Was this innovative? Was this disruptive? Was this disruptive? Was the cell phone disruptive? Okay. Did we all disappear after a cell phone? No. Was the internet disruptive? Did we all disappear after the internet was founded? No. However, if you were an asset management company or if you were a financial advisor who said, मैं phone ही नहीं use करूँगा, मैं internet ही नहीं use करूँगा, would you have been around? Chances are no. So I believe AI is real. It is coming. But it is a co-pilot, not a pilot. I think all of us will have jobs to do. But if we don't know how to use this, then we have a challenge. So I sometimes question, the extreme thesis around AI. There was someone who told me when I was in Baroda that Infosys, their hiring has changed because of AI patterns. 6 महीने पहले AI आया, Infosys के result अभी वो हो गए हैं. Come on. So let us be aware of the new technology that is coming out, but beware also of falling to false narrative.
Yeah, so I think linking innovation and asset allocation is a bit of a stretch, quite honestly, because asset allocation is driven by a whole host of different factors. What you're talking about is that the ease with which somebody can get an optimal asset allocation now, can that become simpler, and does that mean that Radhika and I will be out of jobs, right, and the rest of us? I've been a fund manager for a good part of my career, and this is not the first time technology, so to speak, is supposedly going to wipe us off the planet, right? Initially, it was algorithm-driven models that were going to take away all our jobs. Then it was obviously taking predictive analytics, adding that onto it, and therefore you were all going to lose your jobs. Now, there is always a doomsday scenario that is painted for every innovation that occurs. But I find that what ends up happening is our ability to utilize that technology. So, I'll use our example, right? Machine learning is something we have been utilizing in our investment process globally for years, right? In certain strategies, it lends itself, and that's what we found. Certain strategies, it lends itself towards that. It helps. And certain strategies are not as effective. If you think about it, if AI-driven or, algorithm-driven models were the answer to all our cures, GFC should not have happened, right? Because there would have been a competing bid for every seller. Well, what happened was, every algorithm is driven by correlations, right? You're effectively trying to reduce the correlation of the asset mix in your portfolio. That is what you are trying to do. In a crisis, correlations all go to 1. So it's immaterial, because then when that happens, all the model spits out is the same. So it doesn't matter which fund house had it, all of them were saying you have to sell it now. So I don't necessarily think that it is one size fits all and it's going to be either feast or famine, right? It is how do you utilize it, right? And that, I think, even as advisors, it is going to be critical to be able to utilize this technology, understand it. And just because AI spits out an asset allocation does not make it kind of the truth, right? You have to apply some level of, and that's where I think one of the earlier panelists in that talked about that human intelligence is still far superior to anything a machine can do, right? So I just feel that it's not I think there is no real kind of panacea, so to speak, that, you know what, if I run it through Chat GPT, give me the best asset allocation, then I'm going to go to sleep at night. It is not going to work, and some folks that do that are going to find out the hard way.
Yeah, Suresh, should you like to add anything?
No, I think we have discussed enough. I'll just say that, a few years back, the same thing was said in case of wealth management, that robo-advisory will come and the advisor will have no space. But the reality is advisors have stayed, they've grown, essentially because what happens is, in a bad market situation, your robo does not give you comfort. If the market were to fall tomorrow 10%, you want to go back to your advisor and want to understand as to what to do now. The screen does not tell you what to do. The screen just shows you red, red, red. And therefore, I think somewhere or the other, having that human connect would remain important irrespective of how much technology advances. And I do think investment and advisory are a little high-touch business, particularly from a distribution or, let's say, wealth management standpoint.
Right. So sorry if anybody else had any question, but I think on that note, we can conclude the panel. Thanks a lot to my panelists for their insights, their thoughts, and thanks to the audience for their attention. Thank you so much.
Thank you very much, Josh, for facilitating that incredible panel. I'm going to request all our panelists to please step forward. Let's take a quick group photograph. Ladies and gentlemen, that was our final power panel of the evening. Can we have a huge round of applause? And while this photograph is being taken, thank you so much. Please enjoy the rest of your evening. I want to remind you, earlier today I spoke to you about how important your feedback is to us. I think you have been given physical feedback forms as well. My team was distributing them earlier while the panel was going on. You can, of course, go ahead and fill in the, that particular feedback form. Else, you can scan the QR code, which is on the screen right now, and you can fill in your feedback. On that note, we have two more speakers who are from the Mint team who are going to quickly wrap this up for us. Please join me in welcoming Alakesh Bhattacharya, Deputy Managing Editor, Mint.
Good evening. Can you hear me at the back? Maybe I need to bring this closer. Yeah, thank you. Thank you, Zinnia. So, thank you all for coming. It's been quite a wonderful day, lots of insights. I don't claim to be a mutual fund expert, unlike my very intelligent colleagues in the Mint team, like Neil and his team. Neither am I part of your industry. So then what am I doing here? You see, I am part of one of those 10 crore investors that bring you your AUM. And that is important. Right? That makes me important. So I'm feeling a little chuffed about it. But you see, how do you make sure that I invest more? Or more like me invest in mutual funds? There has been definitely an increase. Like Anant Narayan, he pointed out 46 lakh crore AUM in mutual funds, huge AUM in other areas also. So, very good scenario, lots of growth. I think COVID had a lot of role to play in this spurt in the investments in mutual funds. A lot of retail investors came into equities, came into stocks, came into mutual funds. A lot of young people came. There were a lot of fintech companies who put out a bunch of very simple advertising with simple messages. Just take my app, do this. You don't need to do anything else. That simplicity, I think, is something that the legacy mutual fund investor, players need to bring. Like Radhika was saying, you have the least expensive debt fund in the industry, but nobody knows. That is partly your fault, right? Because why don't I know about it? I should know. That means there is a gap in your messaging. That gap really needs to be addressed. I think Swaroop Mohanty showed us a chart, right, where it showed us that the AUM to GDP in our country is about 15% compared to 85% in other countries. That is a fairly large gap. And that fairly large gap can be addressed and needs to be addressed. Because only then our stock markets also get more stable, right? With FPIs, whenever they, over the last 2 years, what have we seen? Even when FPIs are selling, the markets are not tanking because the DPIs are stepping in. That never used to happen before. At least I don't remember it. That change that has happened is good, which means that more and more people of India are investing in stocks through you as well as directly, right? Now it's up to you really to make that stronger. Make the messaging simpler. Bring more women. Like you rightly said, more women leaders like Radhika are also needed in the industry. It's not just women investors. I take great pride in my wife who handles money much better than I do. She may not be the literate finance the way that we would, stereotype, but she has a far better finance brain than I have. So she helps me with investments without really understanding the intricacies of mutual funds. I heard a lot of discussions today. Some of them I absorbed and learned. Some of them went here because this is an industry forum where you're talking about alpha, beta, gamma, quant, etc., right? Which you all understand, but the investor does not. Investor doesn't really need to understand, but they need to understand the outcome of what you are doing and what you are giving them. That, I think, is really critical, and that messaging needs to come through very, very clearly, whether you want to do regional language models, like, I think Varun Sridhar was talking about, regional languages. Where is the education in regional languages? You're talking about NAV, you're talking about SIP. Everything is in English. Maybe that's one way. I'm sure you're already working on them. And so these are good times. And there is no reason why the mutual fund industry will not keep this growth going forward. I look forward to it. I'd like to thank my colleagues, Neil, Josh, Shashint, and Shipra. They've done a phenomenal job of pulling this event together. Next year, it will be the 10th anniversary of this event. This year is the 9th. It's a wonderful thing, and till then, I'll see you. Maybe next time we'll meet again. Thank you all very much.
Thank you so much, Alakesh. Thank you for putting things so clearly into perspective. And now I'd like to invite Mr. Neeraj Singh, who is the Chief Revenue Officer, HT Media West, to kindly share his thoughts with us as we close the Mint Mutual Fund Conclave. Go ahead.
Ladies and gentlemen, I think we are way over time, so it won't take much time. But before we bring the curtains down to this event, the 9th Mint Mutual Fund Conclave, let me just share some of the stuff which has already been shared with Alokesh and some more. That Mint has been an integral part of this exciting journey of mutual fund industry over the last few decades. And we promised that we would continue to support the efforts of the industry in attaining the vision of 100 trillion rupees of AUM over time through our editorial efforts. So #content. It was great to have all of you here this evening, and thank you for making the evening so engaging and insightful for all of us. We look forward to seeing and hosting you over the next event, the 10th Mutual Fund Conclave. And I would like to close this event by thanking everyone, my colleagues and our partners who sponsored this event. Let me name the names: Axis Mutual Fund, Bandhan Mutual Fund, Baroda BNP, Paribas Mutual Fund, ICICI Prudential Mutual Fund. Mirai Asset Mutual Fund, and UTI Mutual Fund. Thank you, everyone, and have a great evening ahead. All the best. Thank you.
Thank you so much, Neeraj. And yes, a big shout out to our partners. Thank you all for being not just audience, but a very engaging participant. My name is Zina Fernandez. Drinks and dinner have been served. Please enjoy the rest of the evening. And we will see you at the 10th edition of Mint Mutual Fund Conclave. Take care and have a great night. Thank you.